So yesterday we completed section 50B, slum sale. I had given you one question as homework, right? Question number 11. Have you solved question number 11? Yes, question number 11, what is your answer? $31 lakh 18,936. And 27,69,056. Yes, correct. See, question number 11, you have to solve following two different approaches. Number one, as per section 48 proviso 2, taking the indexation from the year in which asset is acquired by the SSE. And then you have to provide alternative solution. You have to provide alternative solution by taking the indexation from the year in which asset is acquired by the previous owner by applying CIT versus Manjula Shah case law. So do one thing, we'll discuss this question number 11 very quickly. Vidyashri has got the correct answer. So others, if you have not got the correct answer, let us discuss. R has acquired a house on 1st September 1999 for 5 lakhs. 5 lakh is the cost of acquisition. R acquired a residential building on 1st September 1999 for 5 lakhs. He spent 25,000 on 1st July 2020 for the improvement of this house property. So 5 lakh is my cost of acquisition. 5 lakh is my cost of acquisition. But this is acquired prior to 1st September, prior to 1st April 2001. He spent 25,000 on 1st July 20 for the improvement of this house property. So the cost of improvement is incurred when? It is incurred prior to 1st April 2001. Any cost of improvement incurred prior to 1st April 2001 cannot be claimed as deduction. Any cost of improvement incurred prior to 1st April 2001 cannot be claimed as deduction. So this 25,000 will not be allowed as deduction. Yes or no? This is the cost of improvement incurred before 1st April 2001. This cannot be claimed as deduction. A further amount of 60,000 was spent by him on 15 November 2003 on improvement of the house. This can be claimed as deduction. Indexation will also be available, and that will be available from financial year 3-4. R gifted the said property to his son on 12th October 2005. On this date, property is gifted. So this is which year? 2005-2006. B also spent the following amounts on improvement. 15th July 2008, 50,000 is spent on improvement. 15th June 2015, 40,000 is spent on improvement. Both can be claimed as deduction. Now it says B sold the house on 30th November 2020 for a sum of rupees 50 lakhs. He has sold the house for sum of rupees 50 lakhs. So this 50 lakhs is what? This 50 lakh will act as a full value of consideration. Expense on transfer were 2% of sale consideration. So sale consideration is 50 lakh. Of that 2% you have to take. That is 50 lakh into 2%, 1 lakh. Compute the capital gain for the assessment at 21-22, assuming that the fair market value of the house on 1st April 2001 is 9 lakhs. See, this property is acquired prior to 1st April 2001. Cost of acquisition is 5 lakhs. Fair market value is given to us 9 lakhs. So generally what we are taking, actual cost of acquisition or fair market value, whichever is higher. But yesterday I explained you one of the amendment, budget 2020 amendment, which says that your fair market value on 1st April 2001 cannot exceed the stamp duty value on first April 2001. So examiner has also given you stamp duty value on first April 2001. Your fair market value is 9 lakh, your stamp duty value is 8 lakhs. So what amount you will consider? You will consider 8 lakh rupees. So 8 lakhs or 5 lakhs, whichever is higher, 8 lakhs will be taken. It is further given that the assistant registrar has adopted a value of 56 lakhs. I had asked you to change this amount to 56 lakhs for the levy of stamp duty. So as per section 50C, will be taking up 56 lakhs as full value of consideration for the purpose of computation of capital gain. Correct? Shall we proceed? So let's move on to that solution. Yes, you know that this property is gifted. This property is gifted by R to his son B. So you have to make solution twice. First solution you will make taking the indexation from which year? From the year in which asset is acquired by the son. That is the year of gift. That is 5-6. And second solution will make as per CIT versus Manjula Shah by taking the indexation from the base year 2001-2002. So let us quickly complete this. My full value of consideration is 56 lakhs. See, very important point to be noted is brokerage na. What is the amount of brokerage given here? 2%. Expense on transfer are 2%. That 2% should not be applied on 56 lakhs. 2% should not be applied on 56 lakhs because 56 lakhs is stamp duty value. 2% is required to be applied on consideration. What is the actual consideration? 50 lakhs. 50 lakh is the actual consideration. Expense on transfer is 2% of that. Please don't take 2% of 56 lakhs. But 56 lakhs is the stamp duty value which government is taking into account for the purpose of calculation of capital gain. But you have actually sold property for 50 lakhs only. So when you pay expense on transfer, maybe it is brokerage paid to the broker. That would be definitely based on 50 lakhs. So your expense on transfer is 1 lakh. So your net consideration is 55 lakhs. Now let's calculate index cost acquisition. As per section 49 subsection 1, when the property is received by way of gift, will, inheritance, succession, devolution, etc., then the cost acquisition to the SSC is nothing but the cost acquisition of previous owner. So can you tell me, number 1, what is cost of acquisition of previous owner? Cost acquisition of previous owner is 5 lakh rupees. That you have to compare with FMV on 1st April 2001. FMV on 1st April 2001 is 9 lakh, but that will be restricted to 8 lakhs. Because of budget 2020 amendment. See, in selling price you are considering stamp duty, so in cost price you should also consider stamp duty. That is what is the logic of the government. So we'll take up 8 lakhs. So 8 lakhs multiplied by indexation of 2021, that is 301, divided by indexation of 5-6. What is the indexation of 5-6? 117. Give me the amount of index cost acquisition. 20,58,120. 20,58,120. Okay. Let us now proceed to calculate the index cost of improvement. Index cost of improvement 25,000, which is given to in the first line, that cannot be claimed as reduction because it is incurred prior to 1st April 2001. Second time the index cost of acquisition is incurred, what is the amount? 60,000 rupees. That is incurred in the year 2003-4. So multiply by index number of 2021, that is 301. What is the index number of 34? 109. Yes, get me the amount. 165,688. Yes. Next amount of cost of improvement is incurred 50,000 into 301, that is 2020-21. Divided by index number of 89. Correct? What is that? 137. How much you are getting? 109,854. Yes, you have one more amount. 40,000 into 301 of the year 2021, and you have to take indexation of which year? 15-16. 254. So what is that amount? 47,402. Now you get me the total of all three. 165, 688, 1,05,854 and 47,402. 322,944. 322,944. Now you take the total of index cost of acquisition 20,58,120 plus 3,22,944. So 23,81,064. 23,81,064. Deduct this amount from a net consideration of 55 lakhs. The applicant should be 31,18,936. 31,18,936. Yes, is that very, very clear? Yes, now let us do the same calculation once again by taking the indexation for base year, that is as per CIT versus Manjula Shah, very quickly. Should not take more than 2 minutes time. 56 lakhs. Minus 1 lakh. is 55 lakhs. Index cost of acquisition 5 lakh, 8 lakh, which one is higher? 8 lakhs. Eight lakhs into 301 divided by 100. 24 lakh 8,000. Index cost of improvement. You can just write as calculated above. You need not calculate once again. This is 32 lakhs, sorry, 322,944. 3,22,944. Get me the total 24 lakh 8,000 plus 322,944. 27 lakhs 30,944. 27, 30, 944. Deduct this from 55 lakhs. 27, 69, 056. 27, 69, 056. Yes. So we have completed this homework. Question number 11. Now we move on to page number 195. I think up to page number 195 everything is done. Nothing is left. We have covered everything up to page number 195. I think one thing is left, that is page number 183. Page number 183 is left. That I will not discuss today. I am going to send you one extra question for that. Page number 183 now. I am going to give you some extra question, extra practical question on that. CE Institute has inserted this in module this year only, May 21 onwards. Earlier we did not have this concept in the module. Actually, this section 48 first proviso is normally taught at CA final level. So we do not have this in. Yes, last year I did not have this concept in the notes. So I have inserted this concept in the current year itself. So page number 183, we have section 48 proviso 1, that we will discuss. That page is left. But for that I am going to give you one extra question. That question also will solve. Along with solution will be provided. I think besides that everything is covered. So now we can move on to page number 195. Page number 195. Capital gain on transfer of intangible assets. Now listen to me very carefully. So we are moving on to a next topic, that is capital gain on transfer of intangible assets. See, intangible assets can be of two categories. Intangible assets can be of two categories. Number one is acquired intangible asset. Intangible assets can be of two categories. Number one is acquired intangible asset. Acquired intangible asset means you have purchased by making the payment. For example, you know that in amalgamation, if the amalgamated company pays something more than the net assets of the amalgamating company, then that extra money which is paid, we say that it is paid for goodwill of the amalgamating company. So in case of amalgamation, you pay extra money to the amalgamating company, that is considered to be paid for goodwill. So you recognize that amount of goodwill in the books of accounts. That goodwill is a acquired goodwill, you have paid money for that. That goodwill is a acquired goodwill. You know what is the cost of acquisition of that goodwill. You also know the year of acquisition. So you have all the information with respect to that goodwill. So if you want to calculate capital gain, you can calculate capital gain in normal manner. There are no complications at all. So here we are saying that these intangible assets are acquired, purchased in exchange of money or money's worth. So in case of these intangible assets, you can easily calculate the capital gain if you want. You can easily calculate the capital gain. Second category of intangible asset is self-generated intangible asset. Self-generated intangible asset means you have not acquired. They are self-generated. Say for example, Manoj has started business. Manoj has started business. Manoj has completed his chartered accountancy, but somehow he is not interested in that practice and doing the job. So he decided to start his own business. And he has started the business of vegetables. He has become a vegetable vendor, not like ordinary vegetable vendor. So what Manoj is doing now? He has hired a few people. They will go to the market early morning. They will get the fresh vegetables. They will clean it. They will cut it into pieces. And then they will do the packing for it. In, say for example, you have to make a potato sabji. Do you understand what it is called as? What Manoj is doing now, he is taking vegetables, he is cutting it, he is cleaning it, and along with these spices, and along with salt, he is mixing everything, and then he is packing in a plastic bag. So if you want to poriyal, if you want to make that, you have to just open the plastic bag, put it in, just boil it. Just open the plastic bag, put it in a container and boil it, that's all. So it is ready to make vegetables, ready to make. He has started this business. He did this business for say 25 years. After 25 years, 30 years, Manoj has decided to retire. So he wants to sell his business. Manoj wants to sell his business. Ready to make veggies. So he is into the business of ready to make veggies. So he is selling his business. Business is sold. Don't you feel he has done business for 25, 30 long years? So he'll have some reputation. He'll enjoy some benefit also. He'll enjoy the goodwill. His brand name will also be there. That brand name which has been created over a period of time by putting efforts for 25, 30 years. That is not a brand name which he has acquired. He has taken efforts for 25, 30 years to build his brand. So now he is selling his business and he is receiving consideration of say 250 crores. Now Manoj claims that out of 250 crores, out of 250 crores for sale of business, I have charged 150 crores. And remaining 100 crores is charged for sale of brand name. Say for example, his brand name is Fresh Veggies. So he has also transferred his brand. He has transferred the brand name to the buyer. So once the business is sold, Manoj cannot use this brand name. Now this brand name is having a long standing in the market. People know this brand. If they want to purchase ready to make veggies, they will just ask for Fresh Veggies. So Manoj says, I have sold the brand name for 100 crores. Now Manoj is calculating capital gains. Manoj has transferred the entire business for a lump sum consideration. So he will calculate capital gain by following section 50B slump sale. So what he is doing now? He has taken the full value of consideration as 150 crores. From that he has deducted net worth. He says 100 crores. And now he says capital gain should be levied only on 50 crores. Capital gain should be levied on 50 crores only. On this 100 crores, Manoj has not paid any tax. Not paid any tax. So he has filed his income tax return. Now the income tax department has picked up his case in scrutiny. An income tax officer has gone through his income computation statement. An income tax officer says that kindly give us the copy of sale of business agreement. You might have sold your business, you might have made the agreement. We want the copy of that agreement. So Manoj has submitted the copy of sale of business agreement. Now the income tax officer reads the entire agreement and then he says that business is not sold for 150 crores. Business is sold for 250 crores. So income tax officer is doing the calculation of capital gain, saying that you should take full value of consideration as 250 crores. Net worth is 100 crores. So your capital gain is 150 crores. But you have paid tax only on 50 crores. So an additional 100 crores, income tax department is asking for tax plus penalty plus interest. Now this case goes to the court. In the court, Manoj makes an argument. Manoj makes an argument saying that I am a chartered accountant. I know what the tax provisions are. I am not in my field, I am into the business, but still I know what tax provisions are. Manoj says that the basic thing in income tax is, we always say that taxability will arise only if there are two things. Number one, there should be a charging section, and number two, there should be a machinery section. Machinery section means it should tell me how to compute the capital gain. Only if both sections are present, taxability can arise. So Manoj says, my calculation is correct. On this 100 crores, I have not paid tax. Why Because the sale of brand name. Question is whether brand name is a capital asset. So I believe yes, it is capital asset, because what is capital asset is not defined. What is not a capital asset is defined in the Income Tax Act. And in that list of exclusion, brand name is not appearing. In other words, brand name is a capital asset. So Manoj says, yes, I strongly believe that brand name is a capital asset. I have sold the business. Along with my business, I have also sold the brand name. And I have charged money for that. So, yes, charging section is there. Charging section conditions are fulfilled. Charging sections conditions are fulfilled. But Manoj says, when I start calculating capital gain for my brand name, I am taking full value of consideration as 100 crores. But from this full value of consideration, what should I take as my cost of acquisition and cost of improvement? That I do not know. Why I do not know? Because this is not an acquired brand name. I did not pay money for acquiring it. I have taken huge amount of efforts for last 25-30 years. I am putting efforts. So because of long standing in the business, brand name is developed over a period of time. I do not know how much cost I have incurred in monetary terms, but non-monetarily I am putting effort since last 25-30 years. And it is impossible for you to quantify those efforts. If you want to quantify, then let me say that those efforts were worth 200 crores. Then you give me deduction as cost acquisition for 200 crores. So I believe that those efforts which I am putting since last 25-30 years for building my brand name, those cannot be monetarily measured. Therefore, besides that, income tax also doesn't talk about anything as to how to ascertain cost of acquisition in case of self-generated intangible assets. Income tax clearly says what should be the cost of acquisition, purchase price plus all other expenses incurred at the time of purchase. But I am not purchased now. This is not my acquired asset. This is my self-generated asset. So I have incurred the cost. What is my cost? The effort which I am putting since last 25-30 years, that is my cost. But it is not possible for me to quantify those efforts. Therefore, cost of acquisition, cost of improvement cannot be ascertained. And since it cannot be ascertained, capital gain cannot be computed. Therefore, machinery section fails. Charging section conditions are fulfilled. Machinery section fails. So there is no taxability. That is the argument of Manoj. That is the argument of Manoj in the court of law. Have you understood the facts? Yes or no? So question is whether the argument of Manoj is correct or incorrect. So court says yes, his arguments are correct. And court has given decision in favor of Manoj, saying that this 100 crores, definitely that is the selling price for the brand name. But since the cost of acquisition, cost of improvement cannot be ascertained in monetary terms, you don't know what is cost of acquisition, cost of improvement, so you can't calculate capital gain. So court gave a decision saying that only 50 crores is taxable. Forget about this 100 crore. For this 100 crores, for charging tax on this, you should have some section in the Income Tax Act which will help you to ascertain the cost in case of self-generated intangible assets. So, there were a lot of cases like this only, wherein businesses were sold and huge amount of money was charged in the name of brand name, or few of them were charging money for sharing the secret formula of production process. For example, Domino's. If you go to Domino's and if you have pizza in Domino's, the taste of pizza would remain the same wherever you go. Throughout the country, wherever you go, the taste of Domino's pizza would remain the same. Because whatever ingredients they are using, those ingredients are made at a central location, in a centralized kitchen which is located in a industrial area. And then those ingredients, spices, etc., they are sending it to the shop. There, the job of a cook is to just bake it and give it to you. And for that baking also, standard operating procedure is defined, that you should take the loaf and you should put it in the baking machine, keep there for 10 minutes. So how to make entire procedure is given. So there is a centralized kitchen, there is a standard operating procedure. So every cook throughout the country working in Domino's is not required to apply his mind, Whatever steps are given to him, he has to just follow the step and make the pizza. So, taste of pizza remains same everywhere in the country. Now, say for example, Domino's is selling the business. Domino's is selling the business. Then Domino's will claim that we have sold the business for 250 crores. We have received consideration of 250 crores. Out of that, 150 crores is the consideration for sale of business, and remaining 100 crores is the consideration for sharing our secret formula of making the pizza. The taste which you get in Domino's pizza is a unique taste. No one else in this entire country is having the pizza with the same taste. So people are buying Domino's pizza only because of that taste. And the recipe of making this pizza is secret. We have found out this recipe by doing research for a lot of years. And this recipe is secret. So we have sold our business. With the buyer, we have shared two things. Number one, we have transferred the entire business. And number two, we have shared that secret recipe of us. That recipe of making pizza is secret recipe, and we have given that recipe to the buyer. For that, we have charged 100 crores. Now, selling price, full value of consideration is known. But what is the cost of acquisition of that secret recipe? That secret recipe was not acquired. It was found out by doing research a lot of years. So, cost of acquisition, cost of improvement for that secret recipe is not known. Not known means it is question mark. Since it is question mark, capital gain cannot be computed. Capital gain is question mark. So Domino's will say that we will pay capital gain tax only on 50 crores. And court has given decision in favor of Domino's, for example. So I am trying to tell you that there were a lot of such cases wherein people used to sell their businesses, they used to charge huge sum of money, and they used to put major amount somewhere for intangible assets. And they used to claim that cost of acquisition and cost of improvement in case of these intangible assets cannot be ascertained because these intangible assets are self-generated. Government got fed up with such kind of arguments, and then government came out with section 55 2AB in the Income Tax Act. Now government says, you do not know what is the cost. How much cost you have incurred, you do not know. For you, cost is not ascertainable. So we are giving you a section in which we are clearly mentioning that the cost of acquisition and cost of improvement in case of self-generated asset should be taken as zero. So now government says cost of acquisition and cost of improvement in case of self-generated asset should be taken as zero. So government has come out with that amendment. So in this case, you will consider the cost of acquisition and cost of improvement as zero. The moment you consider cost of acquisition and cost of improvement as zero, what will happen? You will have a capital gain of 100 crores. On this also you will have to pay the tax. So for making this nil, government has come out with a section. Have you understood the background of the provision? Yes? Yes or no? Okay. Now let us move on to this page number 195 in your textbook. Intangible asset we have divided into two. Number one, acquired intangible asset, and number two, self-generated intangible asset. Self-generated intangible asset means an asset which does not cost anything to the assessee in terms of money in its creation. Such assets are called as self-generated asset. In other words, assessee has not incurred any monetary cost. He has taken a lot of efforts to build his brand. He has taken a lot of efforts to create that secret recipe, secret formula. Dixit says what is loom hours, we'll discuss, don't worry. See, loom hours, that intangible asset called as loom hours do not exist as of now. It do not exist. But still, if you want me to explain, I will explain. Let us go through this entire paragraph very quickly. Generally, there is no capital gain on transfer of self-generated asset. See, now this entire discussion is only for self-generated asset. It is not for acquired asset. Please keep in mind. Acquired asset, capital gain will be calculated in the normal manner. There was no argument with respect to acquired intangible asset. There was controversy and arguments only with respect to self-generated asset. Only for your better understanding, here I have divided the intangible asset into two, acquired and self-generated. In case of acquired intangible asset, capital gain will be calculated in the normal manner. So here we say generally there is no capital gain on transfer of which asset? Self-generated assets. Why there is no capital gain? Because cost of acquisition of such assets cannot be computed. Cost of assets, cost of acquisition and cost of improvement for such assets cannot be computed. But certain amendments have been made in the Income Tax Act. I told you courts were giving decision in favor of the SSE, saying that cost of acquisition and cost of improvement is not ascertainable. It cannot be ascertained. Therefore, machinery section fails. Therefore, there is no capital gain. Now, Income Tax Act is amended, and now capital gain arising on transfer of following intangible assets, following self-generated intangible asset is chargeable to tax. So we have different intangible assets. Here I have given you the list of 6 assets. But in point number 1, you have multiple assets. Number 1, goodwill of business. Goodwill of business. Trademark or brand name associated with business. See, in this point itself, you are having how many assets? 3 assets, if you observe. Number 1 is goodwill of business. Goodwill of business. Number 2, it is trademark or brand name associated with business. These 3 assets are covered in point 1. Point 2, there is something called as tenancy right. Do you understand tenancy right? Yes? Tenancy right means you are occupying one flat, but you are not the owner of that flat. You are just occupying the flat. You are having the right to occupy the flat. You are not the owner. So if you want to sell the flat, you cannot, because you are not the owner. What you can sell is your right of occupation. You can sell the right of occupation. In Hindi, we call this as pagdi system. In Hindi, this is called as what? Pagdi system. So this tenancy right is an intangible asset. Next is route permit. Do you understand route permits? In case of commercial vehicle, you need to purchase or acquire route permit from the government. See, on some truck and tempo, you might see that they have written All India permit. All India permit means that commercial vehicle can be taken to any part of the country. Here I do not know, I am not observed, but in Mumbai, behind the taxi, they will write the name of the city. Say for example, in Mumbai there is a taxi, they will write New Bombay, Panvel, Bhinder. Means these are the 3 locations where this taxi will go. Because the taxi is having permit to go into only that area. So all the commercial vehicles, vehicle which you are acquiring for your personal purpose, that is not a commercial vehicle, that is a personal vehicle. Personal vehicle you can take anywhere in the country without any permit. But commercial vehicles you can take only into those areas wherein you have the permit. So that permit also can be transferred, that can also be sold. Next is loom hours. See, loom hours, this asset do not exist as of now. Loom hours is a artificially created asset. It do not exist as of now. But still if you want me to explain the meaning of loom hours, I will explain you. For example, see, in economics you might have studied something called as seller's market and buyer's market. In economics, you might have studied something called as seller's market and buyer's market. Seller's market means focus will be on producing the goods. Whatever you produce will be sold in the market. But as of now, in practical life, there is no seller's market, there is only buyer's market. But in certain cases, you also have seller's market. For example, in these vaccines, there are only two companies. So whatever they produce, you have to purchase. So seller's market means seller is having a control over the market. He will just focus on manufacturing the goods, and whatever is manufactured will be automatically sold. Because there are no multiple sellers. So for example, in olden days, in textile business, there was a seller's market. So in seller's market, you will have multiple manufacturers. Manufacturer 1, manufacturer 2, manufacturer 3, manufacturer 4, manufacturer 5. Say for example, all of them are into manufacturing textile. And the machines in which this cloth is manufactured, that machine is called as loom. Now in seller's market, focus will be on production. So these people, these manufacturers will manufacture the cloth by using their machine called as loom. And their focus will be on production. Because whatever will be produced can be easily sold. And these looms can run for 24 hours. This loom can run for 24 hours. So textile businesses, looms, they run for 24 hours, and people in those factories, they work in 3 different shifts of 8 hours each. 8 hours, 3 different shifts they work. Now say for example, right now all of them are running their machines for 24 hours. All these manufacturers, they are manufacturing cloth by using the machine called as loom, and they are running their machines for how many hours? 24 hours. So they will produce as much as goods they can produce. Once the goods are produced, goods will be taken to the market and they will be sold. So profit of the manufacturer will depend upon how much more goods he can produce and sell in the market. So in a day, there is only 24 hours. So these people can run their machine for 24 hours, manufacture goods and sell it in the market. Now say for example, in case of manufacturer 1, the salesman which he has appointed, he is very efficient. So there is more demand of goods. For manufacturer 1, demand is more. Because the salesman is very efficient, he sells the goods to a lot of customers and is a very talkative person, convincing person, and he can convince anyone. So the salesman which manufacturer 1 is appointed easily can sell whatever quantity manufacturer is manufacturing. In fact, he says that there is more demand in the market. Actually demand is same, but he is in a position to convince the customer and sell his goods. So manufacturer 1, his machines are working at an optimum level, 24 hours. Now if he wants to manufacture more goods, what he will have to do? He will have to invest money in plant and machinery. Purchase new plant, install that plant in factory and manufacture more goods. So what used to happen in these olden days? These people used to run their machines for 24 hours. Focus was on manufacturing. They would manufacture as much quantity as they could and they would sell it in the market. As a result of which, in the market there is huge supply. In certain cases, supply is much more than the demand. Demand remains the same, but supply is very high. What is the consequence? Price of these commodities will fall over a period of time. So these manufacturers are focusing on supplying the goods in the market, but the demand is limited, na. So as a consequence of which prices are falling. And the moment prices starts falling, na, only this manufacturer will have to suffer the loss because the selling price gets reduced. Then after certain point of time, they cannot afford the reduction in the selling price. So all these manufacturers are incurring loss because of huge goods supplied in the market. So now they have made a union. This manufacturer, they have made a union. Now say for example, manufacturer 1 is appointed as the chairman of the union. Do you know? No? There are manufacturing associations in the country, different manufacturers, they make a group. They have a union. For example, in India, we have bank employees union, we have traders union. So here they have made a manufacturers union and they have appointed manufacturer 1 as a chairman of the union. Now, manufacturer 1, his job is to ensure that prices doesn't fall in the market below a particular level. So manufacturer 1 had a meeting with all the manufacturers saying that why prices are falling, because we are producing more goods and we are supplying more goods in the market. As a result of which in market supply is increasing beyond a particular level and demand remaining at the same level, prices will automatically fall. So to ensure that price remains at some particular level always, we need to do one thing. We need to manufacture less goods so that supply will be less in the market, demand will remain at the same level and slowly prices will automatically increase. So this manufacturer 1, who is the chairman of the entire union, he has convinced all the manufacturers saying that we should reduce our supply of commodity in the market. Everyone is convinced. So they have passed a resolution, they have taken a decision that instead of 24 hours, now we will run our machines only for 20 hours. Now they themselves have decided between themselves that we will allow the machines to function only for 20 hours. So wherever these factories are located, a person will be appointed to look after all these things and that person will allow the machines to run only for 20 hours. Machines can actually work for 24 hours, but they are allowed to work only for 20 hours. So that industrial area will get closed in a span of 20 hours, that's all. In a day's time, you can run your machine only for 20 hours. Now say for example, manufacturer 1 now, in his case demand is more. In case of manufacturer 5, demand is less. Demand is less. To fulfill demand now, he is required to run his factory only for 16 hours. Whatever is demand now, in case of manufacturer 5, to fulfill that demand, even if he is using his looms for 16 hours, he can manufacture adequate quantity of goods to meet the demand. Whereas in case of manufacturer 1, demand is more. Now if manufacturer 1 wants to produce more goods, he has to do one thing. Option 1, he can purchase more looms, he can purchase more machines, install machines in the factory and then manufacture more goods. But that would require huge amount of investment. Second option is manufacturer 1 will go to manufacturer 5. Manufacturer 1 will go to manufacturer 5 and he will say that, see, you are having a permission of running your machines for how many hours? 20 hours. But you are actually running your machines only for 16 hours. And you don't, in your case, you don't have the demand. There is less demand. So anyway, you will be running your factory for 16 hours only now. So you do one thing. You have the right to run your factory for 20 hours, but you are actually running your factory using your machine only for 16 hours. You give your 4 hours right to me. So in case of manufacturer 1, he is also allowed to run the machine only for 20 hours. He is also allowed to run his machine for 20 hours. Now manufacturer 1 will acquire right from manufacturer 5. He will acquire 4 hours right from the manufacturer 5. So now manufacturer 1 can run his machine for 24 hours. 24 hours. So now onwards manufacturer 5 now will always use his machines for 16 hours only. If there is more demand, then in future he'll have to purchase that loom hours from someone else. So loom hour is an artificial intangible asset which is created by the union of manufacturers. There is nothing called as this intangible asset. In olden days, these unions used to agree on a particular point saying that we will run the machine only for 20 hours or so. So this loom hour is an artificial intangible asset created by the union. It is as good as license. It is as good as permit, that we will permit your machines to run for 20 hours. This permit can be transferred. Similarly, loom hours can also be transferred. Dikshit, have you understood the meaning of loom hours? Yes or no? Yes? Okay. Let us proceed further. Point number 5. Right to carry on business or profession. Right to carry on business or profession. Right to manufacture, produce or process any article or thing. See, what do you mean by right to manufacture, right to carry on business, etc.? See, say for example, I am purchasing business from Domino's. Domino's is selling its pizza business to me. After selling pizza business to me, if next month only Domino's also starts the pizza business with some other brand name and they compete with me, then what is the point of me acquiring their entire business? So when I acquire the business from Domino's, in the agreement, I will say that for a period of 5 years, you will not enter into pizza business. For a period of 5 years, you will not enter into a pizza business. For that, I am paying you extra money. So whatever consideration I am paying for acquiring the business, in that I am paying extra sum of money so that Domino's will not enter into pizza business for next 5 years. See, you may say that this is an agreement in restraint of trade, this is not allowed. All these things you might have learned in law, but these things are happening in practical life. These things are happening in practical life. Whenever I acquire the business, I would ask the seller of the business to not enter into that business for a particular number of years. So he will give me a commitment saying that he will not enter into that particular business for 5 years. For that I am going to pay him some extra money. So that is called as right to carry on business. The seller has surrendered his right to carry on business to a buyer. Seller has surrendered his right to manufacture goods using that same recipe. Domino's has given that pizza making recipe to me now. Now they should not use that recipe. Otherwise my monopoly will not be there. So I am paying extra money to Domino's for sharing that secret recipe with me, and they should not use that recipe for next 5 years, and they should not sell that recipe to anyone else also. That is called as right to manufacture, produce or process any article or thing. So we have 6 different points. In point number 1, we are having 3 assets: goodwill of business, trademark of business, brand name associated with business. Then we have tenancy right, route permit, loom hours, right to carry on business or profession, right to manufacture, produce, process any article or thing. This is the list of intangible assets. Now for understanding what should be taken as cost of acquisition in case of this self-generated intangible assets, what should be taken as cost of improvement in case of this self-generated intangible asset, we have bifurcated these 6 points into 2 categories. This is category 1 and this is category 2. See, in category 1 what we have taken? We have taken goodwill of business. This is taken from point number 1. In point number 1 you have 2 more assets, trademark and brand name. That is taken to category 2. That is taken to category 2. See category 1, you don't see that after point 1, how point number 5 is appearing. Where are point number 2, 3 and 4? That we have put it in category 2. So these 6 assets now, we are classifying into 2 different categories. First category, goodwill of business, right to carry on business profession, right to manufacture, produce, process any article or thing. Second category, trademark, brand name associated with business, tenancy right, route permit, loom hours. So all these assets, all these self-generated intangible assets are bifurcated into 2 categories, category 1 and category 2. Now for category 1, government says cost of acquisition should be taken as 0, cost of improvement should also be taken as 0. So in case of first category, self-generated assets, cost of acquisition as well as cost of improvement should be taken as 0. The moment you take cost of acquisition and cost of improvement as 0, what will happen? Your net consideration itself will become the amount of capital gain. So now you can't say that machinery section is failed. Income Tax Act does not provide what should be taken as cost of acquisition. Now you cannot argue in that manner because Income Tax Act has already told you that in case of self-generated intangible asset, you take the cost of acquisition and cost of improvement to be 0. Yes, is that very clear? So now those arguments saying that cost of acquisition cannot be ascertained, those arguments are no more acceptable. You have to take cost of acquisition and cost of improvement as 0. That is what is clearly told in the section. The moment you take the cost of acquisition and cost of improvement as 0, you will have the capital gain and that would be nothing but the amount of net consideration itself. Now let's move on to second category of intangible assets. In case of second category of intangible asset, that is trademark or brand name associated with business, tenancy right, route permit, loom hours. In case of these assets, we are saying that self-generated asset na cost of acquisition should be 0. Cost of acquisition should be 0, but there can be some cost of improvement. Government believes that those self-generated assets which are falling into second category na, cost of acquisition is 0, but there can be cost of improvement. If at all you have cost of improvement, take that amount. If you don't have cost of improvement, forget it. That will be 0. So it is actual capital expenditure incurred by the SSE or previous owner on or after 1st of 2001 on improvement of that asset. So for those assets which are falling into second category, if you have some cost of improvement, take that amount. If you don't have, take it as 0. So what is the belief of the government? Government has clearly now told you that in case of first category asset, cost of acquisition, cost of improvement, both are deemed to be 0. In case of second category self-generated intangible asset, cost of acquisition is deemed to be 0, but you can have some cost of improvement. If at all you have it, you take that amount. If you don't have that cost of improvement, take it as 0. Now let's move on to last 3 important points with respect to discussion of capital gain on transfer of intangible assets. Point A says, see, in certain cases, few people argued that government has told that cost of acquisition and cost of improvement should be taken as 0. That is what government has clearly given in the provision. We understand, yes, whatever government says, that is correct. So we will follow whatever is there in the provision. So few people argued that the business which I am selling now, that business was not started by me. That business was started by my father. That business I have received by way of inheritance. Now I am selling that business. So since I have received this business by way of inheritance from my father, anyway my cost of acquisition and cost of improvement is anyway 0 only. Without government mentioning or without Income Tax Act mentioning anything, my cost of acquisition and cost of improvement is anyway zero, because I had acquired this business from my father by way of inheritance free of cost. I did not pay anything to my father. So my father has transferred this business to me. Now I am not interested into this business, so I am selling it off. So this intangible asset, say for example goodwill of business or brand name of business, my cost of acquisition, my cost of improvement is anyway zero. But you know that when I acquire this asset by way of gift, will, inheritance, succession, devolution or on partition of a share, what do I consider as my cost of acquisition? Is cost of acquisition of previous owner. Now this person argued that government has said you take cost of acquisition and cost of improvement as zero. But government has not said that you should also take cost of acquisition of previous owner as zero. So this person argued that cost of acquisition of previous owner should be taken as zero. Such kind of provision is not made in the Income Tax Act. So cost of acquisition of previous owner is still not ascertainable. So how much is the cost of acquisition of previous owner? Na? That is not known to me, and government has not told anything about it. Therefore it is question mark, and therefore capital gain is question mark, it cannot be calculated. This was the argument of few people. Therefore government came out with an amendment saying that if an intangible asset was self-generated by the previous owner, then also cost of acquisition should be taken as zero. So even if you have received that business by way of inheritance and you are selling the business and you say that my cost of acquisition, cost of improvement is zero, but what is the cost of acquisition of previous owner is not known to me, it is unascertainable. Therefore no capital gain. This argument will not be accepted now, because government has already amended the provision and government has said that cost of acquisition, cost of improvement both should be taken as zero, and if you have acquired the business by way of inheritance, then cost of acquisition of previous owner should also be taken as zero in case of self-generated intangible assets. Have you understood this? So basically job of the government is what? Amend the provision and tell you that everywhere you take zero. Simple. That is what government has done over a period of time in case of self-generated intangible assets. Yes, have you understood this point number A? Yes or no? Okay, let's move on to point B. See, if your business was set up prior to 1st April 2001, if your business was set up before 2001, and as of now you are selling the business, and you might have charged some amount of money for self-generated brand name. In that case, you will argue that as per the provisions made by the government, cost of acquisition and cost of improvement of self-generated brand name should be taken as zero. We accept that. But in our case, we had started our business prior to 1st April 2001. So whenever you have any asset which is acquired or created prior to 1st April 2001, what do you consider as your cost of acquisition for computing capital gain? Is the actual cost of acquisition or fair market value on 1st April 2001, whichever is higher. Government has said take the actual cost of acquisition as zero. What about the fair market value on 1st April 2001? For that government has not said anything. So actual cost of acquisition is zero, but fair market value on 1st April 2001 is not known to us, it is question mark. And since that is question mark, we cannot select what is higher. Therefore, we cannot compute capital gain. And since we cannot compute capital gain, computation provision fails. Charging section conditions are fulfilled, but computation provision fails, because it is not possible to ascertain fair market value on 1st April 2001. So government made the amendment in this provision, and government removed this option of 1st April 2001 in case of intangible assets. So point number B says that option of fair market value on 1st April 2001 is not available. Not available in case of intangible asset, irrespective of whether they are self-generated or whether they are acquired. So, the point which we had discussed, saying that if you have acquired the capital asset prior to 1st April 2001, we don't have the index number of those years. So, we are giving you an option saying that you take the actual cost of acquisition or fair market value of that asset on 1st April 2001, whichever is higher as your cost of acquisition. Such kind of option is not available in case of self-generated assets as well as acquired assets. Which assets? Only intangible assets. So, in case of intangible assets, government has removed this option of fair market value on 1st April 2001 because government says that it is nearly impossible to ascertain the market value of these intangible assets in 2001. Right now also it is difficult to ascertain. How you can ascertain the market value which is prevalent, which was prevalent at that point of time. So it is not possible to ascertain. Therefore, government has removed the option of fair market value on 1st April 2001 in case of intangible assets. Now I move on to the last point. For that I am explaining you something. Say for example, Mr. Manoj, he completed his chartered accountancy and he started his own practice. He started his own practice in the city of Chennai. Manoj and Company Chartered Accountants. He started his own practice. So he is into profession. Now say for example, he practiced for 35 years. He practiced for 35 years. Now he wants to retire. He wants to retire from business. Retire from profession. Manoj's child, he has selected the science stream and he has become a doctor. So Manoj's child is not interested into this CA practice. Ishwar was unable to complete his CA final. So when Ishwar's child was born, first day itself, he decided that my child will become a chartered accountant. So what has happened now? Manoj is going to retire. Manoj's age is 60 years and Manoj's practice, his child cannot take forward because he has become a doctor. Now Ishwar's child has become a chartered accountant. So he wants to set up his own practice. Ishwar's child name is, say for example, Bhagwan. So he has started his own CA firm, Bhagwan and Company, Chartered Accountants. Now Ishwar has gone to Manoj saying that anyway you are retiring, you transfer all your clients to my child. He will manage your client. So Manoj says, I will transfer my practice to your child, but you should pay me some amount for goodwill. You should pay me some amount for goodwill. So here the practice is transferred. See, it is very difficult to transfer a practice in case of professionals. But somehow this is managed. For example, one doctor is retiring. He wants to transfer his practice to a new doctor. Can he transfer his practice? Can he ask all his patients to now get treated through that new doctor? No one would agree. So in that case, what will that old doctor do now? Old doctor will ask that young doctor to come to his clinic, sit there every day. So whenever that old doctor is giving consultation to any patient, he will introduce that patient to the new doctor. Slowly, that old doctor will stop coming to clinic. Instead of 6 days a week, he will come for 4 days a week. Remaining 2 days, you will have only new doctor. After 1 year, he will reduce the number of days from 4 to 2. Then he will stop coming to clinic. And slowly, all the patients of the old doctor will get introduced to the new doctor and they will start coming to the new doctor. Thereby, the old doctor has successfully transferred all his patients to the new doctor. So all the patients, they know the new doctor now. Whenever they fall sick, they will go to the new doctor. For transferring his entire practice to the new doctor, the old doctor has charged say 10 lakh rupees for goodwill. So he has transferred his profession. He has transferred his practice, and for that he has charged 10 lakh rupees for goodwill. Similarly here, Manoj is transferring his practice. In other words, he is slowly transferring his clients to Ishwar's child. For that Manoj has charged 10 lakh rupees. This 10 lakh rupees is charged as goodwill. So Manoj will have to calculate capital gain on this goodwill. This goodwill which Manoj is selling is not an acquired goodwill. It is which kind of goodwill? It is self-generated. It is a self-generated goodwill. So Manoj will have to definitely calculate capital gain in case of this also. Self-generated goodwill. So Manoj will calculate capital gain in case of self-generated goodwill. Manoj says that full value of consideration is 10 lakhs. I have transferred my profession. For that I have charged 10 lakh for goodwill. So full value of consideration is 10 lakh. But what is cost of acquisition and cost of improvement? Na? This goodwill I have created over a period of years by rendering excellent quality of services to my clients. The actual cost of goodwill is not known to me. This is a self-generated goodwill. I have taken efforts, and due to this long standing in my business, goodwill is created. Now Manoj says that cost of acquisition and cost of improvement of this goodwill cannot be ascertained. Income tax officer says no. We have a section in the Income Tax Act saying that cost of acquisition, cost of improvement should be taken as 0. So you take 0 here and your capital gain will be 10 lakhs. You pay tax on 10 lakhs. But Manoj argues that the section which government has made saying that cost of acquisition and cost of improvement should be taken as 0. Manoj says to the income tax officer, refer to that section. It is asking you to take the cost of acquisition and cost of improvement as 0 only in relation to a goodwill of a business. Here they have not used the word profession. Goodwill of business, trademark or brand name associated with business. So they have not used the word profession. So the intention of the government is not to cover profession. And since they have not covered profession, in case of transfer or sale of self-generated goodwill of profession, cost of acquisition and cost of improvement is still unascertainable. That is still unascertainable. Since it is unascertainable, the cost cannot be ascertained. So capital gain cannot be ascertained. So charging section conditions are fulfilled, but machinery section fails. So there is no taxability. This argument was accepted by the court. This argument is accepted by the court, and the decision is given in favor of SSC. To overrule this, now government has not amended the provision. As of now, government has not made any amendment. So what is the situation as of now? What is the situation as of now is, if the goodwill, trademark or brand name associated with business is sold, then cost of acquisition, cost of improvement should be taken as 0. But if goodwill of profession is sold, then cost of acquisition, cost of improvement should be taken as 0. We don't have such kind of section in the Income Tax Act. So as of now, cost of acquisition and cost of improvement in case of self-generated goodwill of profession, cost of acquisition, cost of improvement is unascertainable. Therefore, capital gain cannot be computed and tax cannot be levied. Have you understood this? Yes or no? Yes. So let us read this point number 3. Very important case law. Commissioner of Income Tax versus B.C. Srinivasa Shetty, Supreme Court decision. In this decision, Supreme Court had explained that for charging tax on any income, there should be a charging section, there should be a machinery section. Only if you have this both type of sections, then only tax can be levied on income. Otherwise, tax cannot be levied on income. It says it was held that in order to levy tax on gain on transfer of capital asset, conditions of charging section 45(1) should be fulfilled, and computation provision section 48 should prescribe the computation mechanism. Unless the cost of acquisition is correctly ascertainable, it is not possible to compute capital gain by applying section 48. It is significant to note that section 55, see section 55 means this one. This is section 55. It says now your cost of acquisition, cost of improvement should be taken as 0. This is section 55. It is significant to note that section 55, which says that cost of acquisition in case of self-generated asset shall be taken as nil. This section 55 does not cover self-generated goodwill of profession. So section 55 is silent with respect to self-generated goodwill of profession. Therefore, in respect of self-generated goodwill of profession and other self-generated assets which are not specifically covered by section 55, the decision of Supreme Court in B.C. Srinivasa Shetty case will apply. Means, Supreme Court has said that if there is a charging section, conditions of charging section are fulfilled, but the Income Tax Act doesn't provide you any mechanism for computation of cost, etc. In that case, cost could not be ascertained, and since cost could not be ascertained, capital gain cannot be computed. So in such cases, cost of acquisition cannot be ascertained, and hence capital gain cannot be computed. There is no taxability. There is no taxability. So in case of goodwill of profession, self-generated goodwill of profession, cost of acquisition, cost of improvement, as of now also, it is not ascertainable. And government has not covered that in section 55, saying that cost of acquisition and cost of improvement will be deemed to be 0. If, say, for example, in next year government comes out with an amendment saying that cost of acquisition and cost of improvement in case of self-generated goodwill of profession should also be taken as 0, then in that case, amount realized by sale of self-generated goodwill of profession will also become taxable. But as of now, the situation is cost is unascertainable, and since cost is unascertainable, you cannot compute the capital gain, and since you cannot compute the capital gain, there is no taxability. Yes, is that very, very clear? Yes. So now let's move on to this question number 14. Let us move on to question number 14 very quickly. A very small question. In this, you can see that there are 3 points, point 1, 2 and 3. All these points are independent. They are independent, they are not connected with each other. Means while solving point number 2, you should not have any reference to point number 1. Question 14 says compute the capital gain in the following cases. Compute the capital gain in the following cases. Point 1 says P had commenced a business on 15th April 2000. The said business is sold by P on 18th April 2020 and he has received 8 lakhs towards goodwill and 3 lakhs towards trademark of business. Now tell me whether this goodwill and trademark, are they acquired goodwill and trademark or they are self-generated goodwill and trademark? Nothing is mentioned. If this would have been acquired goodwill and trademark, then definitely examiner would have given you cost of acquisition and cost of improvement. Since cost of acquisition, cost of improvement is not given, and they are saying that you started the business, etc., it is an indication that this goodwill is not acquired goodwill. This is a self-generated goodwill, and this trademark is also a self-generated trademark. And you know that in case of self-generated goodwill of business, cost of acquisition, cost of improvement should be taken as 0. In case of self-generated trademark of business, cost of acquisition should be taken as 0. But you can have cost of improvement if at all it is incurred. If it would have been incurred, the examiner would have given you that amount in the question. But since it is not given, that should also be taken as 0. So in this case, what will be my capital gain? For goodwill, full value of consideration will be 11 lakhs. For trademark, full value of consideration will be 3 lakhs. No expense on transfer, so net consideration is 8 lakhs and 3 lakh respectively. Cost of acquisition, cost of improvement is 0. So my capital gain is 8 lakhs and 3 lakh respectively. So my total aggregate combined capital gain is 11 lakhs. My combined capital gain will be 11 lakhs. Yes, is that very, very clear? So question number 14. Format is given to you for making the solution. Yes, it is on page number 227. Page number 227. So here point number 1A. Period of holding is more than 36 months. So you take the full value of consideration of goodwill and trademark combined. 8 lakhs plus how much? 3 lakhs. That is 11 lakhs. Expense on transfer is 0. So your net consideration is 11 lakhs. Index cost of acquisition, index cost of improvement is 0. So your capital gain is 11 lakhs. Is that very clear? Yes or no? Now let's proceed to second part. Second part, you can refer the question on page number 196. What it says, what will be your answer in the above case if P had acquired the goodwill of this business for a consideration of 2 lakhs? So in case A, you have to give the answer considering goodwill to be acquired goodwill and the cost of acquisition is how much? 2 lakhs. So in that case, you have to make two different columns because this time the goodwill is acquired goodwill and trademark is self-generated. Trademark is self-generated, goodwill is acquired. See, point 1B, goodwill is sold at what price? Yes, goodwill is sold at 8 lakhs. 8 lakhs. So full value of consideration in case of goodwill should be taken as 8 lakhs. Expense on transfer is 0. So net consideration is 8 lakhs. But this goodwill now it has become acquired goodwill. At what price it was acquired? 2 lakhs. Multiply by, you apply the indexation because it is long term asset into 301, that is index number of the year 2021. Divide by index number of which year? Base year 100. The option of FME is not available in this case. Option of FME on 1st April 2001 is not available in this case. So what will be my index cost of acquisition? 6 lakhs 2000. 6 lakhs 2000. So what will be my capital gain? 598. Not 598. 198. 198. Trademark selling price is 3 lakhs. Trademark is still self-generated. So in case of self-generated trademark, cost of acquisition should be taken as 0, but government believes that there can be cost of improvement. If there would have been cost of improvement, examiner would have given you in the question. Since he has not given, it is 0. So 3 lakh is the capital gain on transfer of this trademark. Is that very clear? Yes or no? Yes. Let us move back to the question. Point number 2. Point number 1, story is over. Point 2. R has been living in a rented accommodation since May 2001. R was staying in a rented premises since May 2001 and he is paying a rent of 500 per month. Now you first of all tell me, the rent which is paid is a revenue expenditure or a capital expenditure? Every month 500 rupees rent is paid na? That is a revenue expenditure or it is a capital expenditure? Definitely it is a revenue expenditure. Definitely it is a revenue expenditure. Now my question to you is, while we compute capital gain, we claim deduction for cost of acquisition and cost of improvement. That cost of acquisition, cost of improvement is a revenue expenditure or a capital expenditure? While you calculate capital gain, in that format for computing capital gain, you claim deduction for cost of acquisition and cost of improvement. That cost of acquisition and cost of improvement is of which nature? Is it a revenue expenditure or capital expenditure? Definitely it is a capital expenditure. Meaning thereby, in this point number 2, whatever rent you are paying na 500 per month, that is a revenue expenditure, you cannot claim it as deduction. That is a revenue expenditure. While calculating capital gain, you should not take into account. Don't consider this 500 per month as cost, because this is not a capital expenditure. Further it says the landlord got the house vacated from R on 16 July 20 and paid a sum of rupees 5 lakh for vacating the house. So R has transferred what? Yes, do you believe R has transferred the property? No, because property doesn't belong to him, he cannot transfer. So what is transferred is intangible asset called as tenancy right. What is transferred is intangible asset called as tenancy right. So in case of tenancy right, cost of acquisition should be taken as 0. In case of self-generated tenancy right I am talking. If you have acquired the tenancy right, then you, whatever amount you might have paid at the time of acquisition, you take that amount. But this is a self-generated tenancy right. Cost of acquisition should be taken as 0. There can be some cost of improvement, but in the question it is not given to us. Cost of improvement is also a capital expenditure. So that 500 rupees which is paid as rent, that should not be considered as cost of improvement. So in this case, cost of acquisition, cost of improvement both should be taken as 0. What is the amount he has realized? 5 lakhs. On transfer of tenancy right, he has realized 5 lakhs. Net expense on transfer is 0. Net consideration is 5 lakh. Index cost of acquisition, index cost of improvement is 0. Your taxable long-term capital gain is 5 lakhs. Yes, is that very clear? Yes or no? Now let's move on to point 3. Point 3 says, S is a chartered accountant practicing in Delhi. Yes? Can you judge what the examiner is going to ask you? Definitely goodwill of profession. And you know that in case of goodwill of profession, cost of acquisition, cost of improvement, as of now, it is unascertainable. And since it is unascertainable, you cannot compute the capital gain. charging section conditions are fulfilled, goodwill is a capital asset. But for computing capital gain, machinery section should clearly give you the mechanism of computation. So machinery section as well as section 55, which talks about the cost of acquisition of goodwill to be taken as zero. It doesn't talk about goodwill of profession. It talks only about goodwill of business. Therefore, cost of acquisition and cost of improvement in case of self-generated goodwill of profession is not known to us, is unascertainable. Therefore, you cannot calculate capital gain and there will not be any tax. So, you have to give a reference to case law. Which case law? B.C. Srinivasa Shetty, Supreme Court judgment. So S is a chartered accountant practicing in Delhi since January 99. He transferred the practice to another chartered accountant Y on 15 July 20 and charges 7 lakh towards goodwill. So in this case, nothing is taxable, no capital gain. Give reference to B.C. Srinivasa Shetty case law. Point number 3b. What will be the capital gain in the above case if S had bought the goodwill in January 95 for 50,000? In this case, now that goodwill is not self-generated anymore, this has become a acquired goodwill. So in case of acquired goodwill, you calculate capital gain in normal manner. In case of acquired goodwill, you calculate capital gain in normal manner. So question number 3A, I am not reading it. Reference to this B.C. Srinivasa Shetty Supreme Court judgment is given. And we are saying that cost of acquisition of self-generated goodwill of business is taken to be nil. However, there is no such deeming provision for considering cost of acquisition of self-generated goodwill of profession to be nil. Therefore, if computation provision cannot be applied to a given situation, that amount is not chargeable to tax even if it is covered by the charging section. Meaning thereby, you have the charging section, you don't have the computation provision which will provide the mechanism of computation of capital gain, tax cannot be levied. So therefore in the given case, amount of 7 lakh received on transfer of self-generated goodwill of profession is not chargeable to tax. Let us move on to the last part, question number 3b. Question number 3b. Statement showing taxable capital gain. This goodwill has now become a acquired goodwill. It is sold at what price? 7 lakhs. So consider this 7 lakhs as your full value of consideration. Expense on transfer is 0. Net consideration is 7 lakhs. Cost of acquisition is how much? 50,000. But you know that in case of intangible assets, you don't have the option of fair market value on 1st April 2001. But yes, you can take the benefit of indexation. So into 301, that is index number of the year of transfer 2021. Divided by index number of the base year 2001-2 because this goodwill was acquired prior to 1st April 2001. Yes. So what is that amount? 1 lakh 50,500. 1 lakh 50,500. Index cost of improvement is 0. So what is the taxable capital gain? 549,500. Yes, is that clear? Yes or no? Now let us do one thing. Let us do the stock taking. Which provisions are over? I think we have covered till yes 50D we wanted to discuss. 50D. See, just below section 50C, we have two sections which are not yet discussed. So we'll discuss that. Right now it is 8:46. So as usual, we will have a break at 9 o'clock. So what I am doing now, I am taking up small sections. I am taking up small sections. Can you give me that page number of section 50C? Yes. You can move on to page number 191. You can move on to page number 191. I'll explain you section 50CA in around 2-3 minutes time. This is not important at CA intermediate level. This section is discussed at CA final level in very much detail. CA Institute module itself says that rule number 11UA will be taught to you at CA final. But still, in MCQ, they can ask you anything. That is the reason I am covering this section. Listen to me very carefully. Listen to me very carefully. See, capital asset. I am dividing capital asset into 3. For explaining you this provision, I am dividing capital asset into 3. Number 1, land and building. That is immobile property. Immobile property. Number 2, unlisted shares. Unlisted shares. And number 3, other capital assets. Other capital asset means any capital asset other than land and building, other than unlisted shares. Now, first of all, we will talk about land and building. My question to you is, can you do manipulation to save the tax? For example, you are having a residential building, its market price is 1 crore. So you sell that building for 1 crore, but make an agreement only for 20 lakhs and accept remaining 80 lakhs in black money by cash and pay tax only on 20 lakhs. Can you do such things as of now? No. Why? Because in case of immobile asset, you already have section 50C, which says that if your stamp duty value is more than 110% of agreement value, then we will consider your stamp duty value to be full value of consideration, and accordingly we will calculate capital gain. In other words, it is not possible for you to sell the land and building at a higher price and accept money in cash and pay less tax. Such kind of manipulation as of now it is not possible. Yes, it is possible to certain extent. It is possible to certain extent, because yesterday when I explained you section 50C, I told you that the stamp duty value is ascertained by the municipal corporation by conducting the survey. Municipal corporation will conduct the survey and find out the selling price of a property, whatever price is prevalent in the market. But such survey is conducted by the municipal corporation once in 8 to 10 years. So if in your case, survey was conducted before say 6 years, then at that point of time, the market value would have been something different. As of now, market value would be something different. Definitely as of now, the market value would be higher as compared to what it was before 6 years. So as per the municipal records, the stamp duty value will be less, but the actual market price as of now will be more. So to that extent, still people are accepting cash. Still people are accepting cash to that extent. I do not know whether you understood or not what I tried to explain you. Have you understood? Yes or no? Yes. So I am trying to tell you that in this construction business, in case of this deals with respect to immobile properties, huge amount of black money was involved. As of now also it is involved. Why it is involved? Because the municipal corporations are not revising the amount of stamp duty every year. They are conducting survey once in 8 to 10 years, as a result of which the market price increases slowly. So the stamp duty value is generally lower as compared to the market price. So in my case, if the property value is 1 crore, I am selling it at 1 crore. What I will do now? Before making an agreement itself, I will see what is the stamp duty value of the property. I will defer to the ready reckoner. I will see the circle rate. I will see the stamp duty value. And stamp duty value, say for example 70 lakhs for my property. And the actual market price as of now is 1 crore. So I am selling the property at 1 crore. I will make the agreement anything beyond 70 lakhs. So say for example I am making an agreement at 75 lakhs. Then remaining 25 lakhs still as of today also I will accept in cash. On that 25 lakhs, government is not going to get any capital gain, because while calculating capital gain, I will take into account only 75 lakhs which I have accepted by check. So moral of the story is, as of now also, that black money is getting generated in case of sale of these immovable property deals, but the extent is slightly lower. In relation to unlisted shares also, we have a similar section, similar to section 50C. Here we have a section 50CA. See, unlisted shares, since it is not listed on a stock exchange, what people used to do now? People used to sell the unlisted shares at a very low price. They used to accept money in check. They used to accept lower amount in check, and major portion they used to take it in cash only. Thereby, they were not paying tax on capital gain. So government was forced to come out with a similar section for intangible asset. So now government has come out with a similar section for unlisted shares, similar to section 50C. For immobile property, government is already having 50C now. Same to same sections with slight change, they have introduced section 50CA, which is applicable in case of unlisted shares. 50CA simply says, see, in case of immobile property, you have stamp duty value. In case of movable property, you don't have stamp duty value. So, here government says, if the fair market value of this unlisted shares is more than the actual selling price, if the fair market value is more than the actual selling price, then we will take this fair market value as the full value of consideration, and we will ignore actual selling price. Say for example, you have sold the shares of private company. Shares of private company are always unlisted. You have sold the shares of private company. Actual selling price is, say for example, 50 lakhs. But out of 50 lakhs, you have accepted 20 lakh by check and 30 lakh in cash. So while calculating capital gain, what you will do? You will take into account only 20 lakhs. So government is not going to get the amount of tax on the entire amount. Government will get tax only take into account 20 lakhs as full value of consideration, the amount which you have received by check. So with the intention to ensure that we have a section similar to section 50C, which was made for immobile property, government came out with 50CA. Now government says that we will find out the fair market value. And if the fair market value is more than the actual selling price which you are claiming, you have actually sold the shares for 50 lakhs, but you are saying that I have sold it for 20 lakhs. because you have accepted only 20 lakhs by check. So in that case, government says we will ascertain the fair market value, and if fair market value is more than 20 lakhs, then we will take fair market value as full value of consideration for computing capital gain. Have you understood this? So there is nothing new to learn in this section 50 CA. It is just that we have a separate independent section which is applicable in case of unlisted shares. And instead of stamp duty value, here they are taking what? Fair market value. Here they are taking fair market value. Now read this provision. In order to ensure that the full value of consideration is not understated. See, in my example, I had sold the asset, sold the unlisted share at 50 lakhs, but I accepted only 20 lakhs by check, and remaining 30 lakhs was accepted in cash. So what I have done? While calculating capital gain, how much I would take into account? Only 20 lakhs. Meaning thereby, I have understated my full value of consideration. If I understate my full value of consideration, my capital gain will be lower amount. Government will get less tax. So, government has come out with section 50 CA to tackle such kind of manipulation. In order to ensure that full value of consideration is not understated in case of transfer of unlisted shares, section 50 CA provides that where consideration received as a result of transfer of such capital asset being unlisted shares is less than the fair market value. Consideration received is less than the fair market value. Then such fair market value shall be deemed to be full value of consideration for the purpose of computing capital gain. Now the question is, how this fair market value will be ascertained? This fair market value will be ascertained by following rule number 11 UA. And this rule number 11 UA is not part of your CA intermediate syllabus. Still I am just telling you that rule number 11 UA says that you pick up the balance sheet and you calculate net asset value per share. Net asset value per share is nothing but assets minus liabilities divided by number of shares. You can also call it as intrinsic value per share. You have learned amalgamation chapter now. So intrinsic value you might be knowing. So rule 11 UA has prescribed some methodology for calculating the fair market value. That is nothing but the intrinsic value methodology. But you are not required to know all these things right now. You have to just know one line conclusion of section 50 CA is what? If the fair market value is more than the actual selling price in case of unlisted shares, then fair market value will be considered as full value of consideration for the purpose of computation of capital gain. That's all. Let's move on to this last section, 50D. 50D says what? See, 50D section was also introduced to overrule one case law. And actually that situation is slightly complicated. I don't want to take that example. I will take a very simple example. You may feel that this is no way connected with income tax, but I'll make you understand by taking that example only. Say for example, Ishwar is owning one factory shed. Do you understand a factory shed? Factory shed is nothing but factory premises. Ishwar is owning one small factory premises of 1500 square feet in some industrial area. There might be industrial area here, na? In Maharashtra we call it as MIDC, Maharashtra Industrial Development Corporation. So here you might be having Tamil Nadu Industrial Development Corporation. So Tamil Nadu Industrial Development Corporation might be somewhere. It is nothing but an industrial area wherein you will find only factories. So in such industrial area, Ishwar is having a factory shed, factory premises of 1500 square feet. Now I want to purchase that factory premises. So I went to Ishwar saying that you are not running your own factory, you have stopped the business. That is what I came to know. So I want to purchase your factory premises. So Ishwar is asking me, what you are going to do in that factory? Which plant you are going to set up? You are in which business? So I told Ishwar that we are in the business of manufacturing Cadbury. We are in the business of manufacturing chocolates and Cadbury. So we'll set up a plant to manufacture chocolate and Cadbury. So Ishwar says that, oh, I will sell my factory premises to you. I will give you free of cost. You do one thing. Instead of giving consideration, we will make an agreement that you provide free of cost chocolates to my entire family throughout our life. Whatever amount of Cadbury and chocolates you want to have, we can take from you. And I will not charge you even 1 rupee for this factory premises. I am giving you this factory premises free of cost. So Ishwar has transferred this factory premises to me. What is the consideration? Is he knowing the quantum of consideration? He knows that yes, consideration is received. What is that consideration? In future, his entire family is going to get chocolates and Cadbury free of cost. So there is a consideration, but that consideration cannot be ascertained. The exact amount of consideration is not ascertainable. And since the exact amount of consideration is not ascertainable, you do not know what is full value of consideration. There is a capital asset is transferred also, it is transferred during the previous year also, charging section conditions are fulfilled. But you do not have the exact amount of consideration, it is not possible for you to ascertain the amount. In such a situation, government has come out with section 50D. Government says you cannot ascertain the consideration, don't worry, still you will have to pay the tax. You calculate capital gain, and while calculating capital gain, what you should consider as full value of consideration is whatever was the market price of that factory building. You take that market price itself as full value of consideration. So basically you have to consider fair market value of the capital asset transferred as the full value of consideration for the purpose of computation of capital gain, if at all you are not in a position to ascertain the exact consideration. So section 50D is not covering a specific situation. It is just saying you that whenever you feel that you have received some consideration for transfer of capital asset, but you cannot ascertain the exact amount of consideration, what do? Whatever capital asset you have transferred, you take the fair market value of that capital asset for the purpose of computation of capital gain. For the purpose of computation of capital gain, you take the fair market value of that capital asset. Yes, have you understood this section 50D? So it says where the consideration received or occurring as a result of transfer of capital asset by an SSE is not ascertainable or it cannot be ascertained, then the fair market value of the said asset on the date of transfer shall be deemed to be full value of consideration as the result of such transfer. So with this we have covered up to section 50C and 50D. So I think I have covered everything up to page number 196, everything is over. See here point number F is also over. Section 55A, section 55, you take it as part of homework today. This you take it as part of homework today, we will discuss tomorrow. Section 55, you take it as part of homework, we will discuss tomorrow. Section 50 already covered in PGVP chapter, 50A already covered in PGVP chapter. So, we'll have a break, and after the break we are going to discuss some important situations, circumstances in which capital gain is required to be calculated by separate methodology. Special situations we are going to discuss. Like if you had acquired the debentures, those debentures were redeemed, and at the time of redemption. Instead of money, you have received equity shares. Now you are selling the equity shares. So how we should calculate capital gain in such a situation? Such kind of situations will be discussed. I don't have practical questions on this. So I will be taking some examples and discussing these situations. So we are left with 2-3 small points, and after that not 2-3 small points, 5-6 small points, which may take around 45-50 minutes time or maximum 1 hour, and thereafter we will move on to second part of the chapter, and that second part of the chapter is nothing but exemption calculation, capital gain exemption. Second part of the chapter is very, very important, and that is exemption. Yes. So we are on page number 199. Page number 199 in your book. Now the concept which I will be discussing, for those concepts I do not have a practical question in the notes. So I will take some numerical example to make you understand. The first point is capital gain on conversion of bonds, debentures or debenture stock or deposit certificate of that company into shares or debentures of that company and its subsequent transfer. So I will make you understand this with the help of an example. But before that, I think before the break, I explained to section 50CA, but this part now I did not discuss anything. Section 50CA says what? 50CA simply says, if the fair market value is more than the actual selling price, then fair market value will be considered as full value of consideration for computing capital gain. So we have a section for immovable property, we have section for unlisted shares. For other assets now we don't have any section. We don't have any section. For other assets, since we do not have any section, say for example gold jewelry. I am owning a gold jewelry, its market price is 5 lakh rupees. I am selling that gold jewelry for 5 lakhs only, but I am showing that I have received only 4 lakhs. I will receive 4 lakh by check and 1 lakh in cash. Whatever I have received by cash will not be taken into account while computing capital gain. Is there any section which can prevent me from doing this? Answer is no. There is no section. So for land and building, we have a section. For unlisted shares, we have a section. For other assets, we do not have any section. So here still some kind of manipulation can be done. For other assets, some kind of manipulation is possible. So if I sell my gold to you at a price which is lower than the market price, then income tax department does not have any section to catch me. So I will record my selling price to be lower than the market price. Accordingly, my capital gain will be less. If capital gain is less, I have to pay less tax. So such kind of manipulation is still possible. In case of which sections? Sorry, in case of which assets? Other assets. Other assets means other than land and building, other than unlisted shares. Yes? Is that clear? Last part? Have you got this? Now I move on to page number 199, conversion of bonds into debentures. By taking an example, I will make you understand. Say for example, it is 2011-12. 2011-12. There is a company and there is an investor. This investor has provided funds to the company and company has issued the debentures. This happened in which year? 11-12. Now let me tell you that cost of acquisition of this debenture is 5 lakhs. Face value, or let me tell that it is 1000 debentures into 500 rupees each. This is the way I have arrived at the amount of 5 lakhs. Now the point is, what is the treatment in 2011-12? In the 2011-12, what is the treatment? So answer is, there is no treatment in 11-12 because capital gain is not gain on acquisition, it is gain on transfer. And we are thinking from the point of view of investor. We are not thinking from the point of view of company. We are thinking from the point of view of investor. So, will there be any capital gain in the hands of investor? So, here we are saying that investor has acquired debentures. At the time of acquisition, there is no capital gain. Capital gain is at the time of transfer. Now, second event is happening in the year 16-17. 16-17, these debentures are redeemed. These debentures are redeemed. And these debentures were convertible debentures. In other words, at the time of redemption, company is not going to give back money to the investor. The investor would return the debenture certificate. In exchange, that company is going to issue equity shares. Company has issued what? Equity shares. If you think from the point of view of investor, investor has transferred debentures. Investor has transferred debentures. Now, if you recollect section 45, subsection 1, which is the charging section under the Income Tax Act. In this section, we say that taxability will arise if number 1, there is a capital asset, number 2, there is transfer of capital asset, number 3, there is a transfer during the previous year, and number 4, such capital gain is not exempt. Such capital gain is not exempt. Let me write, taking proper space. Section 45, subsection 1 is the charging section in this head. If the conditions of charging sections are fulfilled, then only tax can be levied on a particular income. So here we are saying that taxability equals to, number 1, you should have a capital asset. Number 2, such capital asset should be transferred Number 3, such capital asset should be transferred during the previous year. And number 4, capital gain should not be exempt. Capital gain should not be exempt. Now the question is, from the point of view of investor, what he has transferred? He has transferred debentures. Is it a capital asset? Yes. Is it transfer? Yes. Whether the debenture are transferred during 16-17 previous year? Yes. Gain is not exempt? Yes, it is not exempt. All the conditions are fulfilled. So ideally what should happen? Investor should calculate capital gain on transfer of debentures. Investor should calculate capital gain on transfer of debentures. But if you levy capital gain tax in the hands of investor, he may not have money to pay the tax, because in exchange of debentures he has not received money, he has received equity shares. So government says, we'll postpone the collection of tax, we'll postpone the levy and collection of tax. Till what point? Till he is selling the equity shares. So right now we will not levy any capital gain tax. We will levy capital gain tax in future when he sells the equity shares. Therefore, government has come out with section 47. In section 47, government has inserted clause number 10. And government says, when your debentures are getting converted into equity shares, when your debentures are getting converted into equity shares, this conversion of debentures into equity shares, now we don't consider this as transfer of capital asset. Actually it is transfer only, but government, by making section 47, says that we will not consider this as transfer. If government doesn't consider this as transfer, then this condition is not fulfilled now. Then this condition is not fulfilled. In other words, in the year 16-17, because of applicability of section 47 clause 10, what this section 47 says? Section 47 is giving you the list of transactions which are not considered as transfer. It is giving you the list of transactions which government doesn't consider it to be transfer for the purpose of capital gain. In other words, in case of such a transfer, capital gain will not be computed. So in that section 47, some people call that section 47 is a list of exempt transfer. List of exempt transfer means government will not levy any tax if the transaction involves transfer, but the transaction is covered by section 47, because section 47 is a list of exempt transfers, they are not chargeable to tax. So your section 47 clause 10 covers the conversion of debentures into equity shares. Therefore, in the year 16-17, there is no taxability. There is no taxability. So tax will not be levied in the year 16-17. Have you understood till now? Yes? 11, 12, 16, 17, both is over. Now the third event is in the year 2021. In the year 2021, investor is selling his equity shares. Investor is selling his equity shares. Equity shares are sold. In which year? 2021. So apply the condition of charging section 45 subsection 1. For a taxability to arise, number 1, there should be capital asset there should be transfer of capital asset. Such transfer should be during the previous year, and such capital gain should not be exempt. Do you believe that equity shares is a capital asset? Definitely yes. If they are listed, they are covered by category 1. If they are unlisted, they are covered by category 2. Are they transferred? Yes, they are sold. Sale is considered as transfer. Are they transferred during your previous year 2021? Yes. Do you have any exemption section to exempt the capital gain arising on transfer equity shares? No. So this is not exempt. So all these conditions are fulfilled. Therefore, you will have to compute capital gain. So capital gain will be calculated in the year in which equity shares are sold. So converting your debentures into equity shares, at the time of redemption, your debentures are getting converted into equity shares. At that point of time, we will not levy any tax on capital gain. We will levy tax in the year in which equity shares are sold. So in this year, previous year 2021, capital gain tax liability will arise. Now the point is, from which year I should take my period of holding? I am calculating what? I am calculating capital gain on transfer of equity shares. So the question is, should I take the period of holding from 11-12 or should I take the period of holding from 16-17? That is the question. So government says take it from 11-12. 11-12 to 2021. 11-12 to 2021. This is written in rule 8AA. This is written where? This is written in rule 8AA. This period of holding we are taking from 11-12 because of rule 8AA. Now, full value of consideration. Say for example, selling price of equity shares is 12 lakhs. So you take full value of consideration as 12 lakhs. From that you deduct expense on transfer, which is say for example 0. So your net consideration is 12 lakhs. Is it a long-term asset? Yes. If it is listed, apply the period of holding of 12 months. If it is unlisted, apply the period of holding of 24 months. But in any case, this is long-term asset. So you have to calculate long-term capital gain. Since you have to calculate long-term capital gain, you will claim deduction for indexed cost of acquisition. Now the point is, what is the cost of acquisition in this case? Can you tell me what is the cost of acquisition of equity shares here? Yes? What is the cost of acquisition of equity shares? Equity shares were acquired on exchange of debentures. Actually, you have not paid anything for acquiring equity shares. But you have given your debentures now. Those debentures were acquired by you for 5 lakhs. So government in section 49 subsection 2A says that cost of acquisition of equity shares should be taken as nothing but cost of acquisition of debentures only. So what was your cost of acquisition with respect to debentures? 5 lakhs. So this cost of acquisition of debentures should be taken as cost of acquisition of equity shares. Now the point is, you should take indexation from which year? Definitely up to 2021. There is no doubt in that. Index number of 2021 is 301. But you should take indexation from which year? Should we take it from 11-12 or 16-17? So government says take it from 11-12. Get me the index number of 11-12. Yes. What is the index number of 11, 12? 184. Now get me the index cost of acquisition. What is index cost of acquisition? Eight 17,935. 8,17,935. So what is my long term capital gain? Yes. What is my long term capital gain? $382. 065. Have you understood the calculation? Yes. What should be taken as period of holding? What should be taken as cost acquisition? Conversion is not considered as transfer. So I have taken a numerical example to make you understand. Now listen to me very carefully. I took an example wherein your debentures were converted into equity shares. This is one possibility. Another possibility is your bonds can get converted into equity shares. Your bonds are let me take less space. Your debentures are converted into equity shares. Converted into equity shares. This is one possibility. Another possibility is your bonds are converted into equity shares. Another possibility is your debenture stock is converted into debentures. Do you understand debenture stock? Yes? Do you understand debenture stock? Debenture stock is nothing but debentures only, but without denomination. Without denomination. Debenture is with denomination, debenture stock is without denomination. Another possibility is deposit certificate. Yes, do you understand deposit certificate? Deposit certificate is nothing but a fixed deposit kept with companies. Fixed deposit kept with companies is called as deposit certificate. We call it as public deposit certificates. So you have kept your deposit FD with companies. That deposit certificate is converted into equity shares. Or maybe your preference shares are convertible preferences. Your preference shares are convertible preferences. So all these things are converted into these things are converted. Things written on the left hand side, when they are converted into things written on the right hand side, then taxability provisions are same. Or we can say income tax provisions are same. Income tax provisions are same. Whatever we have discussed till now in this example, these things are applicable when your debenture gets converted into equity, or your bonds get converted into equity, or debenture stock gets converted into debentures, deposit certificate gets converted into equity, or preferences gets converted into equity. Provisions are 100% same. So look at this page, page number 199. Capital gain on conversion of bonds, debenture, debenture stock or deposit certificate. Into what? Into shares or debentures of that company. So these things are written here. You can read this at home. I have taken an example to make you understand. Next point is capital gain on conversion of preference shares into equity shares and its subsequent transfer. Subsequently, what is transferred? Equity shares is transferred. So sections are different. Section numbers have changed. Section numbers have changed, but the provision remains the same. Section number is changed, but provision remains the same. So this also you can refer it. I have already explained you. You can refer this. Now we move on to transfer of beneficial interest in securities. Transfer of beneficial interest in securities. Now, I do not know whether you are aware about the stock market or not. If you want to purchase the shares, what you will have to do? Are you aware about the stock market? How the process takes place in the stock market? So I will explain you. Section 45 2A. This section I am explaining you. Listen to me very carefully. Do you recollect I had taught you one concept in the chapter of PGBP while discussing depreciation. I explained you something called as legal owner versus beneficial owner. Legal owner versus beneficial owner. Do you know any broker? Dixit is asking me, if the investor has not sold the equity shares, then what? Then no capital gain. Capital gain will arise only when the investor is selling the equity shares. Yes? Oh, one page is left here in between. Have you understood, Dixit? Capital gain taxability will arise only when these equity shares, things appearing on the right hand side, are transferred. Only at that point of time, capital gain taxability will arise. Now I am explaining you section 45 subsection 2A, not important from examination point of view, But since it is covered in the module, I am not leaving it in option. Say for example, you are an investor. You are an investor. You want to purchase the shares of Reliance. So what you will do? Will you go to the office of Reliance in Mumbai saying that I want your shares? No, na. You will go to the broker. You will go to the broker. You will open an account with him. Two accounts are opened. Two accounts are opened. Now say for example, broker is also rendering depository services. So when you open an account with the broker, there are two accounts. Number one is Demat account and number two is trading account. Number one is Demat account and number two is trading account. Demat account is in the name of investor. Demat account will be in your own name. But this trading account, this is a pool account. Pool account means the account in which shares will be delivered. Shares will be delivered in a pool account. This pool account is in the name of broker. Now say for example, you have opened Demat account and trading account with the broker. Now we want to purchase the shares of Reliance. So we will ask the broker to place an order. We will ask the broker, purchase the shares of Reliance. We will ask the broker. Now say for example, there is a stock exchanger. Stock exchange. So broker will place an online order with the exchange. Order for purchasing shares of Reliance. Once the broker has placed the order for shares of Reliance, stock exchange, there will be a lot of people who will be ready to sell the shares of Reliance. So there might be a seller, there might be a buyer. It is a market where seller and buyer will meet each other virtually online to sell and purchase the shares. So someone might sell the shares and this broker has acquired the shares. Shares will be delivered in a trading account. In which account shares will be delivered? In trading account. You have acquired, the broker has acquired the shares on your behalf. Shares are delivered. When the shares are delivered, they are delivered always in trading account. These shares broker has acquired for you. They are delivered in trading account. Now within 2 days, you have to make the payment for the shares. You have to make the payment. Some brokers will ask money from you in advance only. But if at all some broker has not asked advance money, then he will ask you to settle the amount within 2 days. The moment you settle the amount, after 2 days, he will transfer these shares from trading account to your Demat account. So your shares will be transferred from trading account first shares will be always delivered where? Trading account. Thereafter it will be transferred where? To Demat account. Now in future, if you want to sell the shares, you will ask your broker to place a sell order with the exchange. The broker will sell the shares in the exchange. Once the shares are sold, you have to make the delivery of the shares. You have to deliver the shares. Where the shares are lying? Shares are lying in your demat account. So you have to fill up a slip. The way you have a bank account now, in that your money is lying. If you want to pay money to someone, you make a check in the name of that person. Similarly, in your demat account shares are lying, you have asked the broker to sell that shares. So broker has placed the order for sale and someone else has purchased those shares. The order is executed, but for now completing the order you have to deliver the shares. These shares are lying in your demat account. You fill up one slip saying that I have sold 500 shares, you will put your signature and this slip you will submit to the broker. With the help of that slip, broker will take shares of Reliance from your demat account. Without your signature, no one can take out the shares from your demat account. So you have, I am not audible. Are you all getting my voice clearly? Yes. Dikshit? Now it is fine. Okay. Now listen to me. I was telling you that now if I want to sell the shares of Reliance, I'll ask my broker to place a sale order. Broker will place the sale order with the stock exchange. That sale order will be executed. Once the sale order is executed, I will be asked to deliver the shares. Now these shares are lying in my demat account. I fill up a slip. I'll submit this slip to the broker. With the help of that slip, broker will withdraw shares from my account. That slip is as good as a check only, similar to check. The functioning of slip is similar to check. I will sign the check, then that person can take that much amount of money from my account now. Bank will take that much amount of money from my account and they will transfer to someone else's account. Similarly, I will have to sign a slip. That slip I will submit to the broker. Broker will take out that many shares from my account and he will deliver the shares. Those shares will be delivered to the person who has purchased. Have you understood the entire process? How these transactions would take place? How this entire process is taking place? Yes? Okay. Now listen to me carefully. Say for example, I came to know that the price of shares of Reliance. Once you want me to summarize, 5-6 sentences I will try to summarize entire process. Any investor who wants to invest money in the shares of company, if he wants to purchase the shares of the company, then first of all he will have to open a account with the broker. Two types of accounts are there: demat account, trading account. Demat account will be in the name of investor, trading account will be in the name of broker. Broker is the owner of that trading account. That account is also called as pool account. Now if you want to purchase the shares, the investor will have to place an order with the broker saying that I want to purchase the shares, and broker in turn will place the order with the stock exchange. Once the order is executed, then the person who has sold the shares will deliver the shares to the broker. Those shares delivery will come in the trading account. So shares, when they are delivered, they will be delivered in the trading account. It is called as pool account. That account is in the name of broker. Now investor is expected to pay money for the shares which he has acquired. Once the money is paid, the shares will be transferred from trading account to the demat account. Demat account is in the name of investor. Now in future, if the investor wants to sell the shares, he will ask the broker to place the sale order. sale order will be executed, and then the investor would be expected to deliver the shares. For delivering the shares, he has to fill up a slip, and that slip he has to give it to the broker. Broker will remove that much amount of shares from the demat account, and he will give the delivery of the shares to the person who has acquired the shares. Yes, Dikshit, have you understood this much? Yes? Okay. Now, I am explaining you section 45 subsection 2. Listen to me carefully. Say for example, I came to know that the price of shares of Reliance Industries is going to increase in the next 1 day, 2 day. So today I have immediately acquired 5,000 shares of Reliance. Not with the intention of taking the delivery. I do not have that much amount of money also. I have just bought the shares of Reliance with the intention to sell it tomorrow or day after tomorrow, and on the price difference. For example, the shares of Reliance today price is 1,000 rupees. So I bought 5,000 shares. 5,000 shares I bought. Now shares will be delivered. In which account? They will be delivered in trading account. So for example, by today evening or maybe tomorrow morning, shares are delivered in trading account. Now broker will ask money from me now. So what I am doing now? I am not paying money to the broker. Instead of making payment, I am selling the shares only. Until that time, the price of shares is say 1,100. I bought the shares at 1,000. I sold the shares at 1,100. So I made a profit of 100 rupees per share. And I had acquired 5,000 shares. So 5,000 shares into 100, 5 lakh rupees I have earned. These shares did not get transferred to my demat account. They are sold before transferring the shares to the demat account. Shares delivery was received in which account? Trading account. From trading account itself, shares are sold. And trading account is in whose name? It is in the name of broker. Question is, who has to pay tax on this amount of profit which is made? Who has to pay the tax? Broker has to pay the tax or investor has to pay the tax? Who has to pay the tax? Who has earned money? Who has earned profit? Investor has earned. But those shares were lying in the trading account now. When the shares were purchased, they were delivered in the trading account, and the day on which the shares were sold, they were sold from the trading account only. Shares never reached the demat account of the investor. So in that case, investor has earned money. So definitely we should levy tax in the hands of investor only. Therefore, government says in section 45 subsection 2a that this trading account is in the name of broker. Whatever shares are lying in this trading account, legally broker is the owner. He is the legal owner of the shares, but he has acquired the shares to deliver it to investor. So investor is a beneficial owner of shares. Broker is a legal owner because those shares are lying in his trading account. That trading account is in the name of broker. But investor has acquired those shares. So investor is a beneficial owner. Broker is a legal owner. Taxes should be levied on the amount of capital gain in whose hands? Whether we should levy tax in the hands of legal owner or whether we should levy tax in the hands of beneficial owner, that is the question. Yes, we should levy tax to whom? To the legal owner, broker, or the beneficial owner, investor. So answer is we should levy tax to the investor who is the beneficial owner. Yes, have you understood this? So now let us read this section, section 45 2a. Where any person is a beneficial owner of any securities, then profits and gains arising from the transfer of such securities by the depository means broker, shall be chargeable to tax as income of the beneficial owner of the previous year in such transfer took place, and it shall not be regarded as income of the depository, means broker. It should not be regarded as income of depository who is deemed to be the registered owner of the securities by virtue of section 10 clause 1 of Depositories Act 1996. Yes. So broker will not have to pay the capital gain tax. You have to pay the capital gain tax because you are the beneficial owner. Now we move on to next point, which is very small. Determination of period of holding in cost acquisition on the basis of FIFO method. See, are you aware that as of now in practical life, all the shares are holded in electronic form. You hold the shares in electronic form, there is no physical shares. When you acquire the shares, you are not going to get delivery of shares certificate in physical form. Nowadays, shares are maintained in a demat account in an electronic form. Let me ask you a very simple question. Say for example, you are having a bank account. You are having a bank account. In that bank account, or say for example, you are having 1,000 rupees with you. In that 1,000 rupees, you are having 10 notes of 100 rupees. You are having 10 notes of 100 rupees. This is individual Mr. Manoj. He is having how much? 1,000 rupees. 10 notes of 100 each. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These 10 notes are of 100 rupees each. So he is having how much? Or let me take a small example. He is having 500 rupees. He is having 500 rupees. So in this 500 rupees, he is having 5 notes of 100 rupees each. 100 rupees, 5 notes he is having. Every note, every currency note is having a serial number, na? Every currency note will have a serial number. So I am telling you serial number of the note. A, B, H, J, 1, 2, 3. So these notes are serially numbered. Now my point is, say for example, Manoj is purchasing something for 100 rupees. Manoj is purchasing something for 100 rupees. Now he has to pay 100 rupees. Can he decide which note to give? Out of 100 rupees, 5 notes he is having. He has purchased something for 100 rupees. Can he decide which note to give? Yes or no? Definitely yes. If he wants to give a note of A, B, H, J 125, he can give 125. Serial number 127, he can give serial number 127. But for example, Manoj has opened bank account. Manoj has opened bank account. He has transferred this 500 rupees to the bank. So his bank balance is 500. His bank balance is 500. Now can you tell me in that 500 there are how many notes? Do you have 100 notes of, do you have 5 notes of 100 rupees? Or you are having 10 notes of 50 rupees? Or you are having 1 rupee coins? What you are having in that bank balance? Can you tell me? Do you know the denomination? Yes, do you know the denomination? You don't know the denomination. So now say for example, Manoj is spending 100 rupees. From his bank account, he will pay 100 rupees, na? From his bank account, he will pay 100 rupees. Can you tell me which 100 rupees is being paid out of this 500? While depositing, you had deposited this five notes. While you are paying 100 rupees to someone, can you tell me which note is being given? No. Because when you transfer money in a electronic form in your bank account, it will lose its identity. It will lose its unique identity. Are you understanding? Yes or no? Similarly, let me now change this example. Say for example, Manoj has acquired 500 shares. What Manoj has acquired? He has acquired 500 shares of Reliance. He has acquired 500 shares. This is the certificate number of the shares. This is the certificate number. In olden days, when you acquire the shares, certificate was delivered, and every certificate had a certificate number. Every certificate had a number. So these are 100 shares. You are having 5 certificates of 100 shares. Now, if you sell 100 shares out of this, can you decide which share certificate you should deliver? Yes, definitely. You can decide that any one share certificate should be delivered out of this 5. But instead of this physical shares, if you have a demat account, can you decide which 500 shares you have to deliver? Do you have the control? No. So these 500 shares, out of these 100 shares are delivered. Which 100 are delivered, you do not know. Now say for example, these first 100 shares were acquired at 50 rupees per share. These were acquired at 51. These were acquired at 55. These were acquired at 57. And these were acquired at 59. These 100 shares are sold. And the selling price is, say, 70 rupees. Selling price is 70. Now, if you say that I am delivering the first 100 shares, then the profit would be how much? 20. If you say that those shares which I bought at 51, I am delivering those, then the profit will be 19. If you deliver the shares which were acquired at 59, then the profit will be 11 rupees. So the question is which shares you are delivering. So government says once the shares are going into the demat account, these shares will lose its identity. So what do you do now? You follow the FIFO method. First in, first out. So whenever you sell the shares, those shares which have entered your demat account first will also take the exit first. Those shares which have entered your demat account first, they will also exit first. Is that very, very clear? Yes or no? Yes. So determination of period of holding and cost of acquisition should be based on which method? FIFO method. Now we move on to section 46A. There is something called as buyback of shares. Buyback. Do you understand buyback? Yes? What do you mean by buyback? Buyback means what? Company will buy its own shares. How company can buy back the shares? Company is having 2 options. Option 1, purchase its own shares from the stock exchange, directly from the open market. And option 2, ask the shareholder to give some shares back to you. So company can purchase its own shares. This is called as buyback. Buyback can be done either from the open market by purchasing shares from the stock exchange, or buyback can be done by offering price to the shareholder. So you offer a buyback price to the shareholder, and shareholder will give his shares to company, and company will pay the buyback price. So here we are talking about a situation wherein company is buying its own shares not from the open market but from the shareholder. That situation we are discussing. Now listen to me very carefully. If you recollect, in second chapter, residential status and scope of total income, while discussing section 9, income deemed to accrue or rise in India, I had explained you one point, that was dividend. Dividend paid by domestic companies deemed to accrue or rise in India. At that point of time, I had explained you that up to last year, whatever dividend company used to pay to the shareholders, on that dividend, company used to pay dividend distribution tax, and this dividend was exempt in the hands of shareholder. Company used to pay dividend distribution tax in section 1150, and shareholder used to get exemption under section 10 clause 34. This was the provision up to last year. Now this provision is deleted. Now what is the situation? Company will not pay dividend distribution tax because section 1150 is removed. At the same time, shareholder will not get any exemption in 1034 because this section is deleted. So dividend is now taxable in whose hands? It is taxable in the hands of shareholder. This is the provision as of now, this year onwards, with respect to dividend. Now I want to discuss buyback with you, keeping in mind this provision. Section 46A. We are on which page? In your book, page number 200. Page number 200. See, buyback is done for what? Buyback is done for shares. Shares are bought back. Shares are bought back by which company? Shares are bought back by domestic company. If domestic company is buying back its own shares from its own shareholders, what would be the treatment? Company would be subjected to additional income tax. This is called as buyback distribution tax. BBDT is called as what? Buyback distribution tax. So when a domestic company is acquiring its own shares from the shareholders, in that case, tax will be levied in the hands of company itself and not in the hands of shareholders. The situation is similar to dividend distribution tax situation, which was prevalent up to last year. That when company will distribute dividend to the shareholder, company will be required to pay dividend distribution tax, and that dividend will be exempt in the hands of shareholder. Similar is the situation here right now also. So when a domestic company is buying back its own shares, domestic company would be subjected to additional income tax. This will be called as buyback distribution tax. What is the rate of this tax? 20% plus 12% compulsory surcharge. 12% compulsory surcharge means irrespective of level of income, surcharge will be 12%. So 20% basic tax plus on that 12% surcharge. So 12% of what? 12% of 20%. Plus 4% health and education cess. This company will be required to pay as per section 115 QA. So the effective buyback tax is 23.296%. This company will pay. When the domestic company is acquiring its own shares from the shareholders, company will pay buyback distribution tax. Capital gain will not be taxable in the hands of shareholder. In the hands of shareholder, this capital gain will be totally exempt. In the hands of shareholder, capital gain will be totally exempt from tax. Have you understood this point? Situation 1, is that very clear? Yes or no? See here I have written the note. I have written note here, but now this note has lost its relevance. This note was valid for the last year, that is previous year 1920. Buyback of listed shares by domestic company. See here they are not using the word listed. Buyback of any shares, whether it is listed or unlisted. Company has to pay buyback distribution tax. Shareholder will get exemption in section 10 clause 34A. But prior to 5th July 19, buyback of listed shares by the domestic company was taxable in the hands of shareholder and not in the hands of company. If the shares are listed, if those shares are bought back by the domestic company, then that capital gain was taxable in the hands of shareholder, not in the hands of company. That was prevalent only prior to 5th July 19. Now you are in which previous year? 2021. So as of now, what is the provision? Whether the domestic company is buying back listed shares or whether the domestic company is buying back unlisted shares, provision remains the same, there is no change. Provision remains the same, there is no change. So what is the situation? Company will have to pay buyback distribution tax at the rate of 23.296% and shareholder will get exemption in section 10 clause 34. Yes, is that very clear? Shall I proceed? Okay. Now let's move on to second situation. Second situation says what? Buyback of shares. Here also only shares are bought back. But the company which is buying back the shares is other than a domestic company. In other words, foreign company might be buying back the shares. If foreign company is buying back its own shares from the shareholders, in that case, no tax in the hands of company. No tax in the hands of company. Tax will be levied in the hands of shareholder. Capital gain will be taxable in the hands of shareholder under section 46A. Under section 46A. So shareholder will have to calculate capital gain tax. While calculating capital gain, what amount shareholder should take as full value of consideration is nothing but the buyback price. Shareholder should take buyback price as full value of consideration. All other provisions are same. So point number 2 says amount received from the company. Amount received from company is nothing but buyback price. That buyback price will be considered as full value of consideration in the hands of shareholder and accordingly capital gain will be computed. Accordingly, capital gain will be computed. Yes, have you understood this second point? What is the difference between first and second point? Yes? First and second point, what is the difference? In first point, company is a domestic company. In second point, company is other than domestic company. The first point, company is a domestic company. Second point, company is other than domestic company. In both cases, tax treatment is same or it is different? Tax treatment is same or it is different? Yes, definitely it is different. It is totally opposite. If the shares are bought back by domestic company, tax is levied in the hands of company, not in the hands of shareholder. If the shares are bought back by other than domestic company, then tax is levied in the hands of shareholder, not in the hands of company. But what is common in point number 1 and 2? What is common? In both cases, what is bought back? Shares are bought back. In both cases, shares are bought back. Now you refer to point number 3. Buyback of specified security by any company. So what is different in point number 3 as compared to point number 1 and 2 is, here they are not buying back shares, they are buying back securities. The word security will include debentures, bonds, etc. So company is buying back its own debentures from the debenture holder. Company is buying back its own bonds from the bondholder. Which company? Domestic company or other than domestic company? Both companies. Both companies. So how point number 3 is different as compared to point number 1 and 2 na? Point number 3, what is being bought back is securities and not shares. Point number 3, the company who is buying back the securities can be a domestic company or can be other than domestic company. Tax treatment is same as point number 2. No tax in the hands of company. Tax will be levied in the hands of investor. Capital gain will be taxable to the holder of specified securities as per section 46A. So when that investor is calculating capital gain, what he would consider as his full value of consideration? The buyback price will be considered as full value of consideration. All other provisions with respect to cost of acquisition, cost of improvement, period of holding, indexation, everything would remain the same. Yes, is that very clear? Yes or no? Yes. Now before I forget, let me give you something as homework for today. On this concept, practical question will not be asked in the examination. They are not asking the practical question on this concept in the examination, but still what I have done, I have summarized all the provisions here. I will discuss this, but you have to read it once at home. Then thereafter only I will discuss. See this concept, amalgamation of companies versus taxability in the hands of company and shareholder. So if there is an amalgamation between two companies, what are the tax provisions with respect to different transactions which are taking place as a result of amalgamation? For example, if the amalgamation is taking place, then amalgamating company will transfer all its asset to amalgamated company. So amalgamating company is transferor, amalgamated company is transferee. Similarly, in case of amalgamation, the shareholder of amalgamating company will transfer his shares to the amalgamating company. In exchange, he would receive the shares of amalgamated. So what is the treatment of all these transactions? What is the treatment of all these transactions? That is what we need to discuss in this concept. So I want you to read these provisions at home. Tomorrow when we meet, we will discuss all these provisions in a very quick manner, and we don't have any practical question on this. Practical question on this concept will not be generally asked at CA intermediate level. So in amalgamation, number 1, we have definition of amalgamation. Number 2, what is the taxability in the hands of amalgamating company? What is the taxability in the hands of amalgamating company? Number 3, what is the taxability in the hands of amalgamated company? And number 4, taxability in the hands of shareholder of amalgamating company. These things, you take this as part of homework, read it once. We are going to definitely discuss, but while we discuss this, speed will be very high because these topics are not important for the examination. In CA Institute module also will not find these things. Similarly, we have demerger also. Do you understand demerger? In the chapter of PGBP, I had explained you na. Do you remember I had taken an example saying that there is one company, Reliance Industries Limited. Reliance Industries Limited is into the business of oil and gas, retail and telecom. Now this Reliance Industries Limited is transferring its telecom business to another company, Reliance Jio Limited. So, telecom business of Reliance Industries Limited is being transferred to Reliance Jio. Telecom business is segregated and separated and transferred to a new company called as Reliance Jio. So, in this case, Reliance Industries will be left with two businesses, oil and gas, retail. Reliance Industries will be called as a demerged company. Reliance Jio will be called as a resulting company. And the entire exercise will be called as demerger. So, what would be the taxability in the hands of different persons as a result of demerger? That is what is written here. So, first of all, what is the definition of demerger? Is given in section 2 clause 19AA. Then we have taxability in the hands of demerged company. Then we have taxability in the hands of resulting company. Then we have taxability in the hands of shareholder of demerged company. Similar to amalgamation here also. So these things, taxability in case of amalgamation, taxability in case of demerger. You refer to these things at home. Tomorrow we will discuss. I would not devote more than 15-20 minutes time to both these topics. Maximum 15-20 minutes. Because they are not important for examination, you can refer from ICAI module. You will find out that there are no questions in the ICAI module also. Now I want to discuss taxability of shares, securities which are transferred, and those shares, securities were received by you under employee stock option plan. They were received by you under employee stock option plan. I'll give you 2 minutes time. Refer this section, section 17 to clause 6. Refer this very quickly. Yes. Could you recollect something? Which chapter? Income from salary chapter. This point we have already discussed. One more point I wanted you to read. So now do you want me to explain this? Section 17 subsection 2 clause 6. This I have already covered in the chapter of income from salary, and on this we have solved one question. If you recollect, company had issued shares to the employee at a price of 250 rupees per share. Three different market price were given to in the question. Fair market value of the date of application, fair market value of the date of fair market value of date of announcement of ESOP scheme, fair market value of date of application, and fair market value on the date of allotment. Fair market value of the date of announcement of scheme was 600 rupees, fair market value of date of application was 950 rupees, and fair market value of date of actual allotment was 1250 rupees. So which fair market value we took into account for the purpose of valuation of perquisite is the fair market value of the date of application, that is 950. 950 was compared with 250 and the difference was 750 rupees. That 750 was made taxable to you under the head income from salary by applying the provisions of section 17 subsection 2 clause 6. See this. If you want me to give you the question number, it was question number 9, page number 54 of your textbook. Question number 9, page number 54 of your textbook. If you want to refer, I can give you maximum 30 seconds time. Move on to page number 54, refer that question. Move on to page 54. Refer that question quickly. Based on that question, I am going to do further discussion. So that is the reason I am asking you to refer to that. Page number 54, refer that. I am giving you some time to refer. Yes, completed. Yes. Once you complete, please drop me the message. Completed. Okay. Now, I want you to refer to one point in your textbook, page number 201. In your textbook, page number 201. I want you to refer to section 47, clause 3. Section 47, clause 3. Listen to me very carefully. What is section 47? What is section 45, subsection 1? It is the charging section of income tax. Sorry, charging section of capital gain. It says what? There must be capital asset, there must be transfer of capital asset. Such transfer should take place during the previous year and such capital gain should not be exempt. 4 conditions. What is section 4747? Section 47 is giving you the list of such transactions wherein capital asset is actually transferred, but government doesn't want to levy the tax at that point of time. Therefore, government says, we don't consider this transfer as a transfer. This is an exempt transfer. We will not levy tax right now. All such transactions are listed in section 47. One such point is section 47, clause 3. So, I am giving you 2 minutes time. Refer to this and I want you to do what? See, this is one line provision. This is one line provision. Below that I am having exception. So I want you to refer to the provision. I want you to refer to the exception and identify what is the difference between the provision and the exception. What is the difference between the provision and the exception? That is what I want you to identify. Yes, start reading it. Yes, yes, capital asset includes shares, debentures, warrant, everything. Yes. Deva, capital asset includes shares, debentures, warrants, everything. Yes, have you referred to that point? Shall I start my discussion? Yes, okay. Now listen to me carefully. I am reading that provision in front of you. Section 47 says what? Section 47 clause 3 says what? It says transfer of any capital asset by way of gift or under a will or under a irrevocable trust. Gift means I am giving capital asset to you free of cost. So I am a person giving the gift, you are a person receiving the gift. You are the recipient of gift. I am a transferor, you are transferee. No capital gain tax in my hands. Another possibility is Manoj has died. Before he died, he made a will saying that I am transferring this property after my death. This property will be transferred to my wife. In that case, Manoj's wife has received the property by a will. Third possibility is irrevocable trust. Third possibility is irrevocable trust. Irrevocable means non-cancelable. Irrevocable means non-cancelable. For example, you are getting married. In your marriage, I came. I gifted you something. Then next day morning, I called you up saying that yesterday I gave you gift. Na, give it back to me. Yes, is that possible? No, na. Because gift is always irrevocable, non-cancelable. So, irrevocable means any transfer to a trust, and that nature of transfer is irrevocable, non-cancelable. In such case, we say that capital asset is transferred under a irrevocable trust. Section 47 clause 3 says that any capital asset which is transferred by way of gift, or it is transferred under a will, or it is transferred under an irrevocable trust, that will not be considered as transfer. That will not be considered as transfer. There will not be any capital gains in the hands of transferor. So if I gift something to you, I am a transferor, you are transferee. I will not be required to calculate capital gain because this gift is not considered as transfer in my hands. Have you understood this? Yes or no? Yes? So any transfer of capital asset by way of gift or under a will or irrevocable trust is not considered as transfer. Means transferor is not required to calculate any capital gain. To this provision there is an exception. To this provision there is an exception. The provision says in 3 situations there won't be capital gain in the hands of transferor. Number 1, when the capital asset is transferred by way of gift. Number 2, when it is transferred by way of will. And number 3, when it is transferred by way of irrevocable trust. This is what is written in the provision. Now we have the exception to the provision. Exception to the provision means in that exceptional situation, transaction will be considered as transfer or it will not be considered as transfer. In the main provision, they are saying that these 3 things will not be considered as transfer. So in exception, they will say what? In exception, they will say what? Transaction will be considered as transfer, or they will say transaction is not considered as transfer. Definitely they will say in the exception that transaction will be considered as transfer. So exception says with effect from assessment year 2-3, transfer under a will, transfer under a gift, transfer under a gift or transfer under a irrevocable trust. What is transferred? Shares, debentures or warrants allotted to the employee under employee stock option plan or employee stock option scheme. So if employee had received either shares, debentures or warrants, these shares, debentures, warrants, he is transferring under a gift or a irrevocable trust. Will it be considered as transfer or it will not be considered as transfer? Yes? It will be considered as transfer. It will be considered as transfer. But if you refer to this exception carefully, the provision uses 3 words. Number 1 gift, number 2 will and number 3 irrevocable trust. But exception is not using 3 words. Out of 3, exception has picked up only 2 words. Gift and irrevocable trust. So which word is not covered by the exception? Will is not covered by the exception. Will is not covered by the exception. Have you understood this? I do not know while reading the provision whether you did identify this distinction point or not. So this now I am explaining you with the help of a small flow chart. With the help of a small flow chart I am explaining you. For that purpose, I am classifying the capital asset into two categories. Number one, shares, securities received under ESOPs. And number two, other capital assets. Other capital assets, other capital asset you transfer by way of gift, by way of will, or under irrevocable trust. They are covered by section 47 clause 3. They are not considered as transfer, therefore there won't be any capital gain. Therefore, there won't be any capital gain. This is written in provision, section 47 clause 3. Now proviso, shares, securities are received under ESOPs. They are transferred by way of gift or irrevocable trust. Will this be considered as transfer? Are they covered by section 47 clause 3 or they are not covered? Are they covered by 47 clause 3 or they are not covered? Yes? Vidyashri, they are not covered because they have written that in exception. They have not written in main provision. They have written in exception. So they are not covered by 47 clause 3. So shares, securities received under ESOPs given to someone as gift or under a irrevocable trust. Section 47 clause 3. They are not covered here. If they are not covered by 47 clause 3, will they be considered as transfer or they will not be considered as transfer? Yes? If they are not covered by 47 clause 3, they will be considered as transfer or they will not be considered as transfer? They will be considered as transfer. They will be considered as transfer. So capital gain will arise. Capital gain will arise. But will word is not written in the exception. Will word is not written in the exception means if shares, securities received under ESOPs are transferred under will, then they are covered by section 47 clause 3. They are covered by section 47 clause 3 means they will not be considered as transfer. Means there will not be any capital gain. There will not be any capital gain. Have you understood this? Yes or no? Yes? Now, capital gain will arise only in situation 1. I am dividing in two parts, A and B. So, capital gain will arise in which situation? Situation 1A. 1B, no capital gain. Situation 2, no capital gain. Capital gain will arise only in situation 1A. Now, what is situation 1A? Shares, securities received in ESOPs, received in employee stock option plan are transferred as gift under gift or irrevocable trust. Section 47, clause 3 is not applicable. In other words, they are considered as transfer. Therefore, capital gain will arise. Capital gain will arise. Now, point is, if capital gain arises, the transferor will calculate capital gain. But transferor has gifted, na? Transferor has gifted this share securities to someone. So what consideration he has received? He has received zero consideration. He has not received any consideration at all. These are transferred free of cost. So what should be taken as full value of consideration? For computing capital gain, what should be taken as full value of consideration? Provision says you take fair market value on the date of gift. You take fair market value on the date of gift, or fair market value of the date on which these shares securities were transferred under a irrevocable trust. Have you understood this? Yes or no? Yes. Now tell me, what should be taken as cost of acquisition? What is transferred? What is gifted? Shares or securities which were received by you under ESOP scheme. You are gifting these shares to someone. So we are considering this as transfer. So we are asking you to calculate capital gain. You are calculating capital gain. What you are taking as full value of consideration? You are taking fair market value on the date of transfer as full value of consideration. Now the point is, what you should consider as cost of acquisition. What you should consider as cost of acquisition. Vidyashri says cost of acquisition of previous owner should be considered. Who is previous owner in this case? Who is previous owner? You have received shares from your company under ESOP scheme, na? Employee is not previous owner. Employee himself is transferring the shares. Madam, please understand. Here there is an employee. Here there is a company. This company has given shares to employee in ESOPs. These shares employee is gifting to someone. Shares are gifted. So this employee becomes transferor, and the person to whom shares are gifted, say for example spouse, spouse becomes transferee. So the question arises, when the employee is gifting this, we are considering this as transfer, we are asking him to calculate capital gain. But he has gifted now, so he has not received any consideration. What he should take as his full value of consideration for computing capital gain? So we are asking him to consider fair market value on the date of gift as full value of consideration. Yes or no? Now the question is, what amount should be considered as cost of acquisition? What amount should be considered as cost of acquisition? For that, I am reminding you same example of income from salaries chapter. Company had given you shares at what price? 250. What was the market value of those shares on the date of application? 950. So how much was taken as part of perquisite in section 17 to clause 6? 700 rupees per share was taxed to you under the head income from salaries in section 17 subsection 2 clause 6. So my question to you is, these shares when you sell in future or when you give these shares to someone as gift, you are required to calculate capital gain. What amount you should consider it as capital gain? That is what I am asking. Should we consider 250 as cost acquisition while calculating capital gain? Should we consider 950 as cost acquisition or should we consider 700 as cost acquisition? How much amount should be taken as cost acquisition? That is my question to you. First of all, have you understood the question? Yes or no? Yes? So tell me the answer. What is your answer? Less cost of acquisition. Varshini says, sir, repeat. Varshini, have you referred to that question number 9 of salary chapter? Yes? Yes. If you want, acha, you have referred. So I am asking that question once again. Company has issued you shares at what price? 250 rupees. What was the price taken into account for the valuation of perquisite? 950 rupees. So what is made taxable to you is 700 rupees per share. Correct? Now the question is, these shares you have received now, some amount is already taxed to you under income from salary. Now these shares, in future you are gifting it to someone. So we are saying that this gift will be considered as transfer, you calculate capital gain. Or these shares you are actually selling in future. Sale is a transfer, so we ask you to calculate capital gain. You have started doing the calculation of capital gain. Now the question is, what you should consider as your cost of acquisition? What you should consider as your cost of acquisition? That is the question. Have you understood the question? Now you have only three options: 250, 950 or 700. Yes? Tell me how much amount you paid to the company? You paid 250 rupees to the company. So you should not have any doubt that this 250 you have paid from your own pocket. So this 250 should definitely be forming part of cost of acquisition. Correct? Now next point is, this 700 was taxed to you, na? This 700 was taxed to you under the income from salary. On that amount of 700, you paid the tax. That 700 should also form part of cost of acquisition. Therefore, your cost of acquisition should be taken as 950. That is nothing but fair market value. See, if you are unable to digest this now, let me slightly change the situation and explain you the same thing. For example, I am employer. I am issuing you shares. I am asking 250 rupees from you. And the market price of shares is 950. So what is being taxed to you under income from salaries? 700 rupees. 700 rupees. Because 700 is the benefit derived by you. I am changing this situation slightly. Listen to me carefully. I am giving you 700 rupees. You are my employee. I am giving you 700 from my own pocket. Don't you think this 700 will be considered as your income? I am giving you 700. Why? Oh, I am happy on you. You are my employee, you are working very excellently, exceedingly well. So I am happy, I am paying you 700 rupees. Will this become taxable 700? Definitely yes, as income from salary. Now, I gave you 700 rupees, you already have 250 in your hand. Now you are adding both amounts and now you are giving me 950 rupees and now you are saying that sir, issue me the shares. In that case, what will happen? 700 is taxable to you, na? 700 is taxable to you and now you are paying 950 to your employer and you are asking for shares. In that case, what you would consider as your cost of acquisition? Definitely you would consider 950 because you have paid 950 from your own pocket. Meaning thereby is whether you pay 950 from your own pocket or you pay 250 from your own pocket and 700 is taxed to you under income from salary. Both situations are actually same only. It is just that in the first situation, employer gave you 700 and you are giving back 950 to the employer for purchasing the shares. In that case, 950 is the cost acquisition. You are not having any doubt on that. But I am saying you that instead of employer giving you 700 rupees cash, employer says that you give me only 250 rupees, I will give you shares whose market price is 950. In that case, how can you say me that cost is that 250 rupees? In that case, also cost should be 950 because 700 is made taxable to you under income from salaries. Yes or no? Are you understanding? So are you now convinced that 250 should not be taken as cost, 700 should not be taken as cost? What should be taken as cost is 950? Yes. So cost of acquisition should be taken as what? Fair market value on the date of application. Fair market value on the date of application. Have you understood this? Yes or no? Now last sentence I am telling you, last sentence. These shares securities which you had received under ESOPs, you have not gifted, you have sold. In that case, you should take actual selling price as your full value of consideration. That's all. If you have sold, take the actual selling price as full value of consideration. If you have gifted or you have transferred under irrevocable trust, then you take fair market value on the date of gift. Is that very clear? Yes or no? Yes. So I have discussed this with you. Transfer of shares securities received under ESOPs is discussed with you. Point 1. What is the treatment when these shares securities are received under ESOPs? As per section 17 subsection 2 clause 6, it will become taxable to you under the income from salary. Point 2. What will be the treatment when these shares are either sold or they are gifted or they are transferred under a irrevocable trust? Will that be considered as transfer? Yes. You have to calculate cap again. What is fair market value? If the shares are sold, actual selling price. If the shares are transferred under a gift or under irrevocable trust, then the fair market value on the date of gift. What is cost? Whatever was taken as fair market value while valuing the perquisite in the salary chapter, that 950 itself will become your cost. Situation 2b, shares securities which you had received under ESOPs are transferred under a will. This is not considered as transfer as per section 47 clause 3. Therefore, there is no taxability. So, this paragraph I have summarized here for you. Shares securities received under ESOPs, transferred by way of gift or irrevocable trust, will be considered as transfer. Capital gain is required to be calculated. Point 1b and point 2, no capital gain. Point 1a, capital gain is required to be calculated. What should be taken as full value of consideration? What should be taken as cost acquisition? That is discussed here. So with this, our ESOP story is also over. This ESOP story is over. Amalgamation is given to you as homework. Demerger is given to you as homework. I think now we are left with only two small concepts. Two small concepts we are left with, and thereafter we can move on to exemption. I had a target of completing these two small concepts also before the break, but I think we should have a break and then we should move on to those small concepts. So today what we are going to discuss, listen to me. After the break, I will discuss two small concepts with you. One is reverse mortgage scheme and its taxability. Reverse mortgage scheme and its taxability. Second one is rupee denominated bonds. Rupee denominated bonds. These two things I will discuss with you, which would take around maximum 20 minutes time, and then we will be left with 1 hour 40 minutes. In that, approximately 1 hour, we will be having a discussion on section 5454. This is the most important section. We will be discussing for minimum 1 hour, or 1 hour 10-15 minutes. We will discuss in very much detail. I will be taking numerical example to make you understand the smallest of the things. But once the section 54 is over now, then I will pick up a rapid pace, the aircraft pace. Slowly it will pick up. The moment it takes off now, then the speed will be very high. So once we have completed section 54, then section 54B, 54D, 54EC, 54F will move at a very fast pace. So after the break, we are going to discuss section 54 exemption. Once the exemption is over, what will be left in this chapter is discussion of tax rate, that's all. So by tomorrow, we are going to complete the chapter of capital gain. And if some time is left, tomorrow we will be starting with the chapter of income from other sources also. So we will have a break right now, and after the break, we will start with what? Two small concepts, reverse mortgage and rupee denominated bonds. We will now move on to two small sections. First one is reverse mortgage scheme. Now listen to me, I will explain you the procedure. What happens in this reverse mortgage scheme? This scheme is specifically made for the benefit of senior citizens. This reverse mortgage scheme is made specifically for the benefit of senior citizens. Such a senior citizen who is not having any regular source of income. For example, Manoj has completed his CA. Now he has got married and is having only one child. So he has done the family planning saying that I will have only one child. So this is Mr. Manoj. We have Mrs. Manoj. And we have a small child, Master Manoj. Now this child he has cleared his BCom. Now Manoj has invested entire life savings to send his child to USA. Manoj has sent his child to USA for education purpose. His child has completed the masters in say physiotherapy or some science field basically. Now this child is doing a job in USA. He is doing job in USA and is settled there. He is settled there. So Manoj is having only one child. Manoj has invested his entire life savings in the education of child. He has sent his child for education in USA. His child completed the education and he became a doctor. And now his child is settled in USA. He doesn't have any intention to come back to India. Now, for example, Manoj's child has got married in USA to some girl and now is settled there only. Now, in India, who is residing in India? In India, Mr. and Mr. Manoj is residing. Mr. and Mrs. Manoj. They are residing in India. Child is residing in USA. So Mr. and Mrs. Manoj, they are residing in India. Child is settled in USA. Mr. Manoj, Mrs. Manoj. They both are now senior citizen. They don't have any intention to go to US and settle there. So Manoj is in India along with his wife and the child is settled in USA. Child is sending money to his father and mother, that is Manoj and Mrs. Manoj. Child is sending money every month. Now say for example, Mrs. Manoj died unexpectedly. Unexpectedly she died. Maybe because of COVID etc. She died. Now Mrs. Manoj has left this world. Now only Manoj is there. He is in India and his child is in USA. See, generally what happens now? Generally son will have more attachment towards the mother and daughters will have more attachment towards the father. That is what is the general trend. So after the death of Mrs. Manoj, this child used to send money to Manoj, to his father, regularly every month. After a few months, he started sending some less amount. And after 1.5 years, he stopped sending money to his father at all. So Manoj is not having any income. Entire life saving was invested for getting a good quality education for his child. And now child has become doctor. He is earning huge amount of money. He is settled in USA. Manoj is not having even 1 rupee. It is difficult for him to live life also. Day-to-day expenses also he is not having money. So such a senior citizen who are not having any regular source of income, such a senior citizen who are not having any regular source of income, but they are having their residential house property. They are having the residential house property with a intention to create some regular source of income for such senior citizens. Government came out with the concept of reverse mortgage scheme. In that reverse mortgage scheme, what will happen? This senior citizen will go to the bank. This senior citizen will go to the bank. This senior citizen will go to the bank. He will submit the documents, ownership documents of this property. Ownership document of this residential house property will be given to the bank. Thereby, property will be mortgaged with the bank. Property will be mortgaged with the bank, but this senior citizen himself will reside in this house till he is alive. Till he is alive, he will reside in this house. Documents, ownership document of this house will be mortgaged with the bank, and bank will give some money to that senior citizen. Bank will give money for this mortgage. This money which bank is giving to the senior citizen, either it can be in the form of lump sum amount or it can be in the form of monthly amounts. Either it can be lump sum amount or it can be monthly amount. Say for example, the value of this house property, value of this residential house is 1 crore. documents of this residential house are kept with the bank as a mortgage. Now against that, bank will provide a loan. Say for example, bank has provided a loan of 40% of the value of house, that is 40 lakhs. So Manoj will have 40 lakhs. That 40 lakhs he may keep as FD or he may invest somewhere and he may get regular source of income. With that money, his life will go on. Second possibility, Manoj says, I don't want lump sum amount of money. Do one thing, keep the documents of my property with you and I want only 15,000 every month. So instead of giving me lump sum amounts, you give me 15,000 every month. So in that case, bank will pay 15,000 every month to Manoj. Whatever amount bank is giving to Manoj, whether it is lump sum or whether it is monthly amounts, both are in the nature of loan only. Both are in the nature of loan. So those amounts which is received by the senior citizen by mortgaging the property should not be considered as income. Both are liability. They should not be considered as income. So in this case, a senior citizen not having a regular source of income will mortgage his residential house property with the bank, and against that mortgage he would receive some lump sum amount or either he would receive monthly amounts every month. Whatever amount he is receiving from the bank, whether it is lump sum or whether it is monthly amounts, both are loan only. They are not they should not be considered as a income of that senior citizen. Now, very important point to be noted in this entire reverse mechanism system is why it is called as reverse mortgage scheme. First of all, the documents of the property is mortgaged with the bank and the possession of that property is given to senior citizen only. So, ownership document and possession is handed over to the bank. Then bank will once again hand over the possession by giving the key to senior citizen. In other words, till the time senior citizen is alive, he will only reside in this house. This is very important point. Till the time this senior citizen is alive, he will reside in the house, number one. Number two, till the time senior citizen is alive, bank will not ask him to make the repayment of any amount. Bank will just pay him money. Bank may charge interest on that loan, but that interest bank will not ask the senior citizen to pay. That interest will be recovered after the death of senior citizen. Till he is alive, bank cannot ask for money. Number three, till he is alive, bank cannot sell the property also. So till the time this senior citizen is alive, bank will not ask for any money from him. Bank will not take away his property. Bank will not collect any interest. They will charge interest, but they will not collect. Collection of loan and interest will be done after this senior citizen is died. On the death of senior citizen, whatever amount bank had given to senior citizen, along with interest they would recover by selling the property. So in case of reverse mortgage scheme, what will happen? This scheme is made for the benefit of senior citizen who are not having any regular source of income. So this scheme was framed with the intention of creating a regular source of income for a senior citizen. In this scheme, senior citizen can mortgage their residential house property with the bank and bank would pay them some lump sum amount of money or monthly amounts. If this lump sum amount is given to the senior citizen, that should not be considered as income because that is not an income, it is a loan, it is a liability. Even if amounts are given on a monthly basis, that should also not be considered as income. Tax should not be levied because it is not an income, it is a liability. So here in point number 2, point number 1 I have discussed meaning of reverse mortgage scheme, that you can refer on your own. Point number 2 is taxability in case of reverse mortgage scheme. Reverse mortgage scheme, what is the taxability? So we have section 47 clause 16. We have section 47 clause 15 which says that when a senior citizen is mortgaging his ownership document of the property with the bank, don't equate this with sale of property. Don't equate this with sale of property because he is not actually selling the property. Don't consider this as transfer. Don't calculate any capital gain tax. So when a senior citizen is mortgaging his property with the bank and is getting some money against that mortgage, that should not be considered as transfer and capital gain will not be computed. That is written in section 47 clause 16. So by mortgaging the documents of the property, he is going to receive some lump sum amount. So even though he has received the lump sum amount, don't consider this as transfer and don't calculate any capital gain. Number two, instead of lump sum amount, if he is receiving, say for example, 15,000 rupees every month, then he is receiving money in installments. That should not be considered as income. Even if you consider it as income, government says that is exempt in section 10 clause 43. That is exempt in section 10 clause 43. So any amount received by a senior citizen as a loan, either it is received in lump sum or in installments in a transaction of reverse mortgage, would be exempt from income tax. No tax will be levied on the amount which bank is paying to a senior citizen. Thereafter, I told you that bank cannot sell off the property till that senior citizen is alive. Till he is alive, he will occupy the property. Till he is alive, bank will not even ask for the interest. Now say for example, that senior citizen has died. Senior citizen has died. In that case, now there are two possibilities. Possibility number one, senior citizen has died, Manoj has died. Now Manoj's child is coming from USA to India to complete the last rites of his father. He has completed the last rites. Now bank has called Manoj's son saying that your father had a property, that property he had mortgaged with us and he had taken a loan of 40 lakhs. On that, total amount of interest till now is 15 lakhs. So the outstanding amount is 55 lakhs. If you want that property, then you pay us 55 lakhs. We will transfer the property to you. So for example, value of the property is 1 crore. Manoj had taken a loan of 40 lakh. Interest which had got accumulated is say 15 lakhs. So total what is required to be paid is 55 lakhs. So bank has offered to Manoj's son saying that if you want this property, you pay us 55 lakh and you take the property. So Manoj's son readily paid 55 lakhs to the bank. So what bank will do? Bank will give this property to son of Manoj. In that case, no tax treatment will be given. No tax treatment will be given. Because it is just that child is paying the loan which was taken by his father. And he is getting the mortgage on the property released. By paying how much? By paying 55 lakh rupees. Now the property belongs to son of Manoj. He has received this property by way of inheritance from his father. Now in future, if son of Manoj is selling this property, he will have to calculate capital gain. He will have to calculate capital gain. What he would consider as his cost of acquisition, he has received the property by way of inheritance free of cost. So his cost of acquisition is 0. But as per section 49 subsection 1, his deemed cost of acquisition is nothing but the cost of acquisition of previous one. His deemed cost of acquisition is nothing but cost of acquisition of previous one. Besides that, whatever amount he had paid to the bank, in our example 55 lakhs, that 55 lakhs will be considered as cost of improvement. That 55 lakhs which Manoj, son of Manoj had paid to the bank for getting the mortgage released, that 55 lakh will be allowed to him as deduction, considering it as cost of improvement. Have you understood this? Yes or no? Yes. So now let me move on to the last part of the discussion. Last part of our discussion in this. Second possibility is Manoj has died. Manoj has died. Son of Manoj, he came to India. He completed the last rites of his father. Now bank has said to Manoj saying that your father had taken a loan of 50 lakh from us. Dikshit, I'll complete this point and then I'll summarize. I'll complete this point and then I'll summarize the entire provision for you. Dikshit, are you getting my voice? Yes or no? Okay, okay. Do one thing, I am writing here, I'll write here. Possibility number one, Manoj died. Here there are two possibilities now. Till Manoj is alive, bank is not going to demand any money from Manoj. Bank will not ask Manoj to vacate the property also. Bank will not charge any interest also. Recovery will be done only after Manoj dies. Now, for example, Manoj has died. Now there is possibility number one. There is bank, there is son of Manoj. Son of Manoj has paid 55 lakh to the bank. What is this? Loan plus interest. Loan 40 lakhs, interest 15 lakhs. Total 55 lakh is paid by son to the bank. In that case, property mortgage will be released. In that case, mortgage of the property will be released and son will have a property without any mortgage. Means it is a freehold property. There is no mortgage on it. Now say for example, son has sold the property. Sold property for 100 lakhs. 100 lakhs. In that case, let him calculate capital gain. He will consider 100 lakhs as his full value of consideration. What he should consider as his cost of acquisition? This property he had received from his father by way of inheritance. After the death of his father, he has received the property. So his actual cost of acquisition is 0. But as per section 49 subsection 1, his deemed cost of acquisition is cost of acquisition of previous owner. So whatever was the cost of acquisition of Manoj will become the cost of acquisition of his son. For example, that cost of acquisition was 20 lakhs. So take this as 20 lakhs. From that also deduct cost of improvement. What is cost of improvement? Whatever amount son had paid to the bank for getting the mortgage released, that should be taken as cost of improvement, 55 lakhs. So what will be capital gain in this case? 25 lakhs will be capital gain. 25 lakhs will be capital gain. Is that very clear? Yes? Dikshit? Okay. Now let's move on to second possibility. Manoj has died. Bank has to recover 55 lakhs. But son of Manoj says, I do not have money. I do not have money to pay the tax. Son says, I do not have money to not pay the tax, not repay the loan and interest. Son says, I do not have money to repay the loan along with interest which my father had taken from you. In that case, bank will sell the property. Bank will sell the property. Bank will recover loan along with interest. For example, 55 lakhs in our case. So bank will sell the property. Bank will recover loan and interest. Balance amount, balance amount will be paid to son, will be paid to legal heir, will be paid to the legal heir. So say for example, bank has sold the property for 90 lakhs. Bank has sold the property for 90 lakhs. Out of 90 lakhs, bank has recovered 55 lakhs. Loan plus interest outstanding was 55 lakhs. So bank has sold the property for 90 lakhs. Out of 90 lakhs, they have kept 55 lakh with them. What is the balance left? 35 lakhs. 35 lakhs they have paid to son of Manoj. And this everything is settled. Now in this case there is one question. Who will pay the capital gain tax? Because property is sold. Property is sold. Who will pay the capital gain tax? Whether bank will pay the capital gain tax or son will pay the capital gain tax. For this, nothing is mentioned in the provision of Income Tax Act. Nothing is mentioned in the income tax provisions. There is in Income Tax Act, the provision doesn't mention anything about this. This is silent. So who will pay? That is a very big question mark. But I personally feel that in this case, son should be liable to pay capital gain tax, because you know that all the property of the father by way of inheritance in this case is received by son. Son not only acquires only the property, he also acquires the liabilities by way of inheritance. So any tax liability of father is left to be paid. In this case, son has to pay that. But module is silent with respect to who will pay the capital gain tax in this situation. So with this I have covered the reverse mortgage scheme. Reverse mortgage scheme is over. Alienation means giving away. Alienation means giving away the property. When you sell the property, at that point of time also there is a alienation of property. So this point says that capital gain liability will arise at the stage of alienation of property. What to write in the examination? I don't think that CA Institute will ask you this in the examination. I do not think that they will ask. They had asked the reverse mortgage scheme in the examination, they have asked till now only once. When this reverse mortgage mechanism was introduced for the first time. At that point of time they had asked. Now they are not asking. You can refer to the module. Whatever is there in the module, I have taken in the notes. What you should write in the examination is whatever is given to you here in the notes. That's all. Whatever is given here in the notes now, that same thing you can write in the exam. Shall I proceed? Yes? Okay. Now I will be discussing rupee denominated bond with you. Now I will be discussing rupee denominated bond. Listen to me very carefully. I am going to take an example to make you understand. Say for example, there is one company, Reliance Industries Limited. It's an Indian company. In India, if they take the loan for doing business now, the rate of interest is very high. They want to raise funds from outside India because the interest rates are too low in developed countries. So for example, Reliance goes to USA. And Reliance is issuing bonds to the investors in USA. US investors. There are US investors. So Reliance is issuing bonds. These bonds are rupee denominated bonds. What do you mean by rupee denominated bonds? These bonds are denominated in rupees. In other words, these investors will have to pay money in rupees, not in dollars. These investors are in USA. But if they want to invest money in the rupee denominated bonds of Reliance Industries Limited, then they will have to give Indian currency to RIL. Now say for example, these US investors want to invest money in the rupee denominated bond of Reliance Industries Limited, but they don't have rupees, they have dollars. So say for example, there is an investor Mr. X. There is an investor Mr. X. He is having dollars. So he will go to the forex market. He will go to the foreign exchange market. Or he will go to the bank. Either he will go to the forex market or he will go to bank. He will give dollars. Say for example, he has given $1 lakh. At that point of time, the rate of exchange going on was say 70 rupees per US dollar. So how much amount this forex market, from forex market he would receive how much amount? Or maybe bank will pay him how much amount? 70 lakh rupees. So this investor has got 70 lakh rupees. 70 lakhs. This investor has invested rupees 70 lakhs in the bonds. He has invested 70 lakhs. And he has acquired the bonds. This is the story at the time of issue of bonds. This is the story at the time of issue of bonds. Now, for example, at the time of redemption, what will happen? Reliance Industries Limited will pay money in Indian rupees or it will pay money in dollars? Yes? Reliance had received 70 lakhs. So Reliance will repay this 70 lakhs in dollars or in rupees? They received in rupees, so they will pay back in rupees only. They received 70 lakh rupees. So on redemption, they would pay 70 lakhs. On redemption, they would pay 70 lakhs. Now this US investor has got 70 lakh rupees, but he will need what? He will need US dollars, na? He is not concerned with that rupees, he wants dollars. So what he'll do? He'll go to the forex market. He'll go to the forex market. Rupees 70 lakhs. So now investor is having 70 lakh rupees. Now he is going to the forex market. Here he will sell his rupees. He will give rupees 70 lakhs. And now my point is, when he went to the forex market taking 70 lakh rupees, the exchange rate was 65 rupees per US dollar. Exchange rate was 65 rupees. So how many dollars he would receive? Here the exchange rate was $1 is 70 rupees. At the time of redemption, $1 equals to 65 rupees. $1 equals to 65 rupees. So how many dollars he would receive? 70 lakhs divided by what? 65 rupees per dollar. So 70 lakhs divided by 65 will be how much? Give me the amount. 70 lakhs divided by 65. 1,07,692. So he would receive dollars 1,07,692. He has earned $7,692 extra. He has earned $7,692 extra. At the time of making an investment, he had invested how many dollars? $1 lakh. Now at the time of redemption, by giving the same 70 lakh rupees, he has received 1,07,692 US dollars. So what is the gain? 1,07,692 dollars he has received. And he had given how many dollars? $1 lakh. So what is the gain? $7,692 is the gain. This is gain because of what? This is a gain because of appreciation in the value of rupees. The value of rupee has appreciated. Earlier, $1 was 70 rupees. Now $1 is 65 rupees. So we say that value of rupee is appreciated and dollar is depreciated. Because of appreciation in the value of rupees, this US investor has earned $7,692. This $7,692 will not be taken into account while computing capital gain. While we compute capital gain, this $7,692 will not be taken into account. It will not be taxable at all. At the time of redemption, we will calculate the capital gain. But this $7,692 which he has received extra is because of appreciation in the value of rupees against the dollar. This 7,692 will not become taxable. Have you understood this? Yes or no? Yes. Now I am telling you the last point in connection with this concept. This I explained you, covering the issue of bonds as well as redemption of bonds. Now I am telling you the treatment of transfer of bonds by one non-resident to another non-resident. Say for example, Reliance Industries Limited has issued rupee denominated bonds outside India to Mr. X. And these rupee denominated bonds are redeemable after 5 years. Now, for example, during year number 3 itself, Mr. X is in need of money. So, Mr. X has sold his bonds to Mr. Y. Who is seller of bond? Mr. X. Who is buyer of bond? Mr. Y. Where the bonds are sold in USA. So, when one non-resident is selling rupee denominated bond to another non-resident, if at all there is any capital gain, we are not going to levy any tax on that capital gain. We are not going to levy any tax on capital gain. In other words, capital gain would arise only on redemption of bonds. If the bonds are transferred by one investor to another, capital gain will not arise. Bonds, when one investor is transferring to another, if there is gain, that capital gain will not be taxed in India. But at the time of redemption, definitely capital gain will be taxable. But whatever is gain on account of appreciation of rupees, that won't be taxable. That won't be taxable. Yes, is that very, very clear? Yes or no? Okay. So, I have given you one example here. Similar example is there here also. Illustration, you can go through this illustration. We will go through the provision. Section 48 Proviso 5 says what? In case of SSE being non-resident, any gain arising on account of what? On account of appreciation of rupee against a foreign currency. In our example, rupee has appreciated. Earlier $1 was 70 rupees, now $1 is 65 rupees. So rupee has appreciated. So whatever is gain on account of appreciation of rupee now, at the time of redemption of rupee denominated bonds of Indian company, that shall be ignored for the purpose of computation of full value of consideration. While you calculate full value of consideration, this appreciation of rupee should be totally ignored. It should not be taken into account. So that extra dollars, in our example, that 7,692 extra dollars which he had received, that he had received because of appreciation of rupee, and that will not be taxed. That will not be taken into account while computing capital gain. And now we have section 47 clause 7AA. It says any transfer made outside India. What is transferred? Rupee denominated bond is transferred. These rupee denominated bonds are issued by Indian company. These are transferred outside India. These are transferred by one non-resident to another non-resident. This will not be considered as transfer. This will not be considered as transfer. So we will not levy any capital gain in India. We don't consider this as transfer. So no tax will be levied in India. Yes, is that very, very clear? So we have completed these two small concepts. Now we need to move on to section 54. Exemption series. In your textbook it is page number 205. In your textbook it is page number 205. See, section 54 I will discuss in very much detail by taking an example. Everything will be calculated by taking the numbers. You should have the calci, you should calculate and give me the amounts. Once we have an exhaustive discussion on section 54, if you come across any practical question on section 54, you will be in a position to solve. Even if you pick up the CA final module, comfortably you will be in a position to solve any of the questions. As of now also, after you complete this capital gain chapter, if you pick up the CA final module and you solve the capital gain questions, 100% will be in a position to solve it. So we are moving on to very important section, and that is section 54. What is this section 54? Why such section was introduced? With what intention? All these things we need to understand. For that I am going to take a very small example. You can just keep section 54 in front of you. Anyway, we are not going to have a look at section 54 at all. Till we complete our discussion, we will not have a look at this textbook. I have some additional notes. I will be explaining you this section 54 with the help of this example. Now listen to me very carefully. Say for example, Mr. Manoj completed his chartered accountancy. He completed his CA. Now he is doing job. Thereafter he bought one flat, which is a 2 BHK flat. He has acquired a 2 BHK flat. He has acquired a 2 BHK flat. Now he is married. He is having 3 kids. He is having 3 kids. Now I am doing the fast forward of the entire story after 35 years. After 35 years, all these kids age would be around 30, 32, etc. And Manoj would be a senior citizen. So all these kids they have completed their education, they are doing job, and they are getting decent amount of salary. Now all these kids will also get married. Once they get married, Manoj will have 3 daughter-in-law. Then two kids each. So family will be too big and this house will be too small. So Manoj decided that before these kids get married, he wants to sell off this 2 BHK flat and he wants to acquire at least 4 BHK flat. So Manoj is selling his 2 BHK flat. By sale of 2 BHK flat, Manoj has sold this 2 BHK flat on 15th August 2020. He is selling this 2 BHK flat on which date? 15th August 20. So he is calculating capital gain. Full value of consideration is 1 crore 1 lakh. 1 crore 1 lakh is the full value of consideration. Expense on transfer is 1 lakh. Net consideration is 1 crore. He had acquired this flat, say for example, before 1st April 2001 for 5 lakhs. So definitely you should have fair market value on 1st April 2001, that is 7 lakhs. Now for computing capital gain, you will take actual cost of acquisition or fair market value on 1st April 2001, whichever is higher as cost of acquisition for computing capital gain. So in this example, we are taking 5 lakhs or 7 lakhs, whichever is higher. So 7 lakh is taken as cost of acquisition for computing capital gain. On this 7 lakh, Manoj will apply the indexation. So numerator index will be the index number of the year of transfer, that is 301, and denominator index will be the index number of the base year 2001-2002, because Manoj had acquired this property before 1st April 2001. So he has calculated indexed cost of acquisition to be 21 lakhs 7,000. There is no cost of improvement and gross capital gain is 78 lakhs 93,000. Gross capital gain is 78 lakhs 93,000. Till now, you know everything. I have not explained you anything. I have just put up a format for computation of capital gain in front of you and I have inserted some amounts there. So, up to this point, we have already discussed. There is no need to explain this. You already know how to calculate capital gain. Now, my question to you is, by selling this old 2 BHK flat, how much amount of money Manoj has received? What amount he has received by selling this flat? By selling this flat, he has realized 1 crore 1 lakh. Out of that 1 crore 1 lakh he has already paid as expense on transfer, that is brokerage. So what is lying in his pocket is 1 crore. So by selling this 2 BHK flat, what is lying in the pocket of Manoj is 1 crore. So Mr. Manoj is having a balance of 1 crore. Now he wants to buy a 4 BHK flat. He wants to buy a 4 BHK flat. So he has gone to some builder. He has inquired about it. 4 BHK flat, the cost is 2.5 crores. Cost is how much? 2.5 crores. Now the question is how to arrange this 2.5 crores. So what they have done, Manoj says, I have sold my old residential house property 2 BHK flat. From that I have realized 1 crore. Number 2, Manoj says, I am ready to invest my entire life savings for acquiring this flat so that all my children will get married, they will get settled and we will stay together and I will enjoy my retirement life. So, Manoj is having a life savings of say 90 lakhs. He is ready to invest entire life savings of 90 lakhs for acquiring the flat. Still, he is having a deficit. How much? 60 lakhs. 60 lakhs is the deficit. Now the question is from where this 60 lakhs would come. So what Manoj did now? Manoj has called all his three sons. Now he has explained the situation to all of them, saying that we will need at least 4 BHK flat, then only you can get married. So we'll have to acquire a 4 BHK flat. I have inquired with the builder, costing is 2.5 crores. We can sell our flat for 1 crore. I am having a lifetime saving of 90 lakh, that also I will invest. But still we are having a deficit of 60 lakhs. So what do you do now? Each one of you take a loan from the bank of 20 lakh rupees and we will acquire the flat, and then slowly you go on repaying the loan. So all three sons of Manoj, son 1, son 2 and son 3, they have taken a bank loan of 20 lakhs each. They have taken a bank loan of 20 lakhs each. Then they have sold off their 2 BHK flat and they have acquired 4 BHK flat. Now all of them, entire family is residing in that 4 BHK flat. Now my question to you, one fine day, if Manoj receives a notice from the income tax department saying that you had sold 2 BHK flat, on that there was a capital gain of 78,93,000, you did not pay any tax. So you pay tax on this 78,93,000 at the rate of 20%. For example, let us take the round figure. 80 lakhs is the amount of capital gain. On that long-term capital gain tax rate is 20%. That works out to 16 lakh rupees. If government demands the tax at the rate of 20% on this capital gain, that is 16 lakh rupees, don't you feel Manoj will face undue hardship in payment of this tax? If he has to pay 20% tax on that capital gain, he will face undue hardship. From where he will get 16 lakh rupees to pay the tax? For paying that tax, he will have to ask all the sons to take 5 lakh more loan. So he will face undue hardship. He will face undue hardship. Government doesn't have the intention of giving undue hardship to Manoj in such a situation. See, buying a house is a very big decision in the life of any individual. At that point, in such a situation, instead of taking tax, government should help us. So government says we cannot help you by giving money, but we can help you by not levying any tax. So government says on this capital gain, we are giving you two options. Option 1, what is this capital gain? This is long-term capital gain. On what? On transfer of residential house property. Long-term capital gain on transfer of residential house property. Government says, here we are giving you two options. Option 1. Option 1, you pay tax. Option 1 is what? You pay tax at the rate of 20% on long-term capital gain. Option 2, if you don't want to pay tax, then you claim exemption. Under section 54. So now the question is whether Manoj would like to pay tax or he would like to claim exemption. Definitely he would like to claim exemption. So government says we will give you some exemption in section 54, but you have to fulfill lot of conditions. You have to fulfill lot of conditions for claiming exemption in section 54. Condition 1, this exemption is available only to individual and HUF. This exemption is not available to everyone. This exemption is available only to individual and HUF. In other words, partnership, firm, company, association of person, body of individual, local authority, artificial juridical person, these people cannot claim exemption in section 54. Only individual and HUF can claim exemption. Second condition, capital asset transferred should be residential house property. It should be residential house property. In other words, if you transfer the commercial property, if you are having a shop in some shopping mall, that is a commercial property. If you transfer commercial property, there is a long-term gain. Government is not giving any option here. You have to pay tax only. Exemption is available only in case you have transferred the residential house property. There is no exemption in case of commercial property. If you sell the commercial property, you have to pay tax on capital gain. Third point is nature of capital asset transferred. Instead of word capital asset, now we should use the word residential house property. Nature of residential house property transferred. It should be long-term capital asset. In other words, that gain should be long-term capital gain. Meaning thereby, if it is a short-term asset, the gain is short-term gain, then you can't claim any exemption, you have to pay tax. You have to pay tax. Have you understood till now? Yes or no? Condition 4. Whatever long-term capital gain has arisen on transfer of this residential house property will be exempted from tax under section 54. Manoj will not be asked to pay the tax, provided Manoj purchases or Manoj constructs new residential house property. So what he has to do? He has to acquire new residential house property. In our example, did he acquire new residential house property? Yes, he had acquired new residential house property. Now, very important point to be noted in this connection is there are two possibilities. Either Manoj will purchase the residential house property, he purchased the residential house property, or he will construct the residential house property. Government has given him two options. You have sold your residential house property, long-term capital gain has arisen, you either pay tax or you claim the exemption. If you want to claim the exemption, then you will have to purchase the house property or you will have to construct the house property. If you want to purchase the residential house property, then we are giving you a time limit for purchasing the residential house property. We are giving you the time limit for purchasing the residential house property. That time limit is from the date of transfer. For example, in our example, the date of transfer is 15th August 2020. So government says from this date of transfer, 1 year backward, 1 year past period and 2 years forward, means 2 years future period. This is the time limit in which you should acquire the new property. If you acquire the new property within a span of 1 year backward or 2 year forward, from which date? From the date of transfer, then you will get the exemption. Otherwise, you won't get any exemption. So 1 year backward means from which date? From 15th August 19. Up to which date? 2 year forward. 2 year forward from 15th August 20 is what? 2 year forward period is 14th August 22. And 1 year backward is 15th August 19. So 1 year backward period and 2 year forward period, in this span of time, SSE has to acquire, purchase new property. But if he says, no, I don't want to purchase the new property, then he can do the construction of new property. Means let him purchase the plot of land and let him get the property constructed on that plot of land. In that case, we are saying that from the date of transfer, within a period of 3 years, in our example, date of transfer is 15th August 20. From this date, 3 years period is 14th August 2023. Within this date, within this date, construction of property should be completed. So construction of property should be completed within this period. When the construction can start? Construction can start at any point of time. Can the construction start even before the date of transfer? Yes. If you want to start the construction before the date of transfer also, we don't have any objection. But the point is, this construction should be completed within 3 years from the date of transfer. There is a deadline for completing construction. There is no timeline for starting the construction. You can start the construction at any point of time, but the construction should be completed within a span of 3 years from the date of transfer. Have you understood this much? Yes or no? Yes. Now you tell me one thing. What is your previous year? What is your previous year? Previous year 2021. What is the corresponding assessment year? Corresponding assessment year is 21, 22. Yes or no? Every year you have to file the income tax return, na? Every year you have to file the income tax return. So for the previous year 2021, what is the due date of filing income tax return? In income tax we call it as return of income. We don't use the word income tax return, we use the word return of income. So what is the due date of filing return of income? It is 31st July 2021, or if your books of accounts are getting audited, 31st October 2021. In example, let us take that your due date of filing income tax return is 31st July 21. So keeping in mind all this information, I am once again moving back to my example. Now my question to you is, on which date you will have to file the income tax return for your previous year 2021? For previous year 2021, you will have to file your income tax return by this date. That is 31st July 21, you will file the income tax return. Now my question to you is, when you file your income tax return, in that you have to calculate your income, na? So in that you will also calculate your capital gain on transfer of that old residential house property. Now the point is, will you pay tax on that capital gain, or will you say that I want the exemption, give me the exemption? So definitely you have an intention of claiming the exemption. But for claiming exemption, what you have to do? You have to acquire new property. You have to either purchase new property or you have to construct new property. Have you purchased the new property up to 31st July 21? For example, you have not purchased the property. You have also not started the construction of property. So question is, when you file your income tax return, you have neither purchased your property nor you have started any construction. So the point is, will you claim exemption or will you pay tax on the capital gain? Income tax officer says you pay tax because you have not acquired property. What will be your argument in that case? You will say time limit for acquiring the property is 2 years now, and time limit for constructing the property is 3 years. That time limit expires on which date? 2 years time limit for purchasing the property is expiring on 14th August 22, and 3 years time limit for completing the construction of property is 14th August 23. So today it is 31st July 21 only. I have a lot of time to purchase or construct the property. How can you levy the tax? I am having an intention of claiming the exemption. Now the point is, if you claim exemption right now and in future if you don't acquire the property, then what? Government will not have any control now. Thousands and lakhs of people are selling property, there is capital gain. Everyone will say that we want to claim exemption, we will acquire property in future, and if we give them exemption, they will claim exemption and they will not acquire the property in future. Who is going to keep track record of all these things? So government came out with an idea. Wherein government says that up to due date of, government says up to due date of filing your return of income, there are two possibilities. Properties purchased, properties constructed. Number two possibility, properties not purchased or constructed. So in first possibility, government says if up to the due date of filing return, that is up to 31st July 2021, up to 31st July 21, if property is purchased or constructed, then we will give you exemption in section 54. Section 54 exemption will be given to you. But what if I have not purchased or not constructed the property up to the due date of filing income tax return, that is 31st July? In that case, what will happen? In that case, government says we will give you exemption provided you promise us that you are going to acquire the property. Property is not purchased or constructed. Property is neither purchased nor constructed up to the due date of filing income tax return. In this case, whether government should give you exemption? As an SSC, you are saying that yes, government should give me exemption because they have given me time to acquire the property 2 years and 3 years now. The 2 years, 3 years have not expired. So how can they levy the tax? So government says, if you claim exemption and if you don't acquire the property in future, who is going to keep track of that? We do not have that much resources to keep track of that. So government says, you promise that you will acquire the property. So how will you promise? Will go to the income tax officer and say, I swear I will acquire the property. This is the way in which you will promise him. He will give you exemption, and in future your promise is gone. So government says, if you have not actually acquired the property now, then in that case we have come out with some different mechanism for you. As an SSE, you go to the bank, you go to some bank, with that bank you open a bank account called as capital gain deposit account. You go to the bank, you open the capital gain deposit account and you deposit money in that account. See, you might not have heard the capital gain deposit account earlier. You might have heard savings account, current account, fixed deposit account, recurring account. You might not have heard that there is something called as capital gain deposit account also. Why you have not heard na? Because you have not learned the capital gain chapter also earlier in your life. So you can go to a bank and you can open a account called as capital gain deposit account. So government says up to the due date of filing return, that is 31st July 20, if you have actually acquired the property, if you have actually constructed the property or purchased the property, we will offer you exemption. But if you have not purchased or constructed the property up to the due date of filing return, that is 31st July 21, then we are asking you to go to the bank, open a capital gain deposit account, deposit money in that account, and then we will give you section 54 exemption. Then we will give you section 54 exemption. The moment you deposit money in the account, there is a commitment from your side that yes, these funds will be used in future for purchase or construction of property. So government says we will give you exemption. Have you understood this? Yes or no? Yes? Okay. Now look at this further part of the solution. This example which I have taken, up to this gross long term capital gain, I have already explained to you. Now we will have a look at further part. From this you can claim exemption. You can claim exemption subject to fulfillment of lot of conditions. Number one, exemption is available only to individual HUF. The capital asset transferred should be residential house property. Nature of capital asset transferred should be long term asset. For claiming exemption, SSE should purchase new property or construct new property. Time limit for purchase is 1 year backward from the date of transfer, 2 year forward from the date of transfer. Or if SSE intends to construct the residential house property, then he has to complete the construction within a period of 3 years forward. In that case, he is eligible for exemption. But all these things, if he is not in a position to purchase construction, if he has actually purchased or constructed the property up to the due date of filing return, then we will offer him exemption. But if he has not purchased or constructed the property up to the due date of filing return, then we will give him exemption only if he goes to any nationalized bank, opens a capital gain deposit account and deposits money in that account. Only then he will be eligible to claim exemption. And whatever he has to do up to the due date of filing return. Before he files his income tax return, let him either purchase the property or construct the property or open capital gain deposit account and deposit money in that account. If he is not doing any of these things, then no exemption will be offered. Capital gain tax will be levied. Now let's move on to understand the further part of the solution. Exemption under section 54A, exemption under section 54 will be lower of following two amounts. Exemption under section 54 will be lower of following two amounts. Number one is gross long term capital gain. What is gross long term capital gain in your case? 78,93,000, the same amount. 78,93,000. This is amount number one. Amount number two, we have two parts, part A, part B. What is part A? Amount actually invested. Amount actually invested in new residential house property up to the due date of filing return. Up to due date of filing return, if you have already acquired the property, that amount will be taken into account for the purpose of computation of exemption. Now say for example, here I am telling you that up to the due date of filing return, he has purchased the plot of land at a cost of 30 lakh rupees. Because he is having an intention of constructing the property, he has purchased the plot of land by investing 30 lakh rupees. Plus, he has deposited some amount in capital gain account up to the due date of filing return. How much amount he has deposited in the capital gain account up to the due date of filing return? He has deposited, say for example, 60 lakhs. So what is the total amount? 90 lakhs. 60 lakhs, out of 90 lakhs, 30 lakhs is actually invested and 60 lakhs he is promising to invest. He is promising that he will invest 60 lakhs, and for that he has opened a capital gain account and he has deposited amount of 60 lakhs in the capital gain account. Now very important point to be noted here is, if SSC is depositing any money in the capital gain account after the due date of filing return. What is the due date of filing return in our case? 31st July 21. If SSC deposits any money in the capital gain account after the due date of filing return, then that amount will not be taken into account for the purpose of computation of exemption. Why? Because we have asked him to open the capital gain account up to the due date of filing return, deposit money in that account. Based on that, we are going to calculate the exemption. So while he is filing the income tax return, he should have, by that time, he should have already opened the capital gain account and he should have deposited money in that account also. If he is depositing some amount after that due date, in that case, that amount will not be taken into account for the purpose of computation of exemption. So amount deposited in the capital gain account after 31st July 21 in our example will not be eligible for exemption. Yes, is that very clear? Yes? Okay, now tell me what is my amount number 2? What is my amount number 2? Amount number 1 is gross long term capital gain. What is amount number 2? Amount actually invested or amount actually invested and amount actually deposited in the capital gain account within the due date of filing return, addition of both 2A as well as 2B. In our example, amount number 1 is how much? 78,93,000. 78,93,000. This is amount number 1. What is amount number 2? 30 plus 60, that is 90. 30 plus 60, that is 90. How much will be exemption? Exemption will be lower of following two amounts. Amount number 1 or amount number 2, whichever is lower. So out of 78,93 and 90 lakhs, what is lower? 78,93 is lower. So 78,93 will be exempt from tax. What is taxable is 0. What is taxable is 0. Have you understood till this point? Yes? Okay. Now I am asking you very important question, because further part of the discussion also, that amount is going to play a very important role. Now you tell me, what is the amount of capital gain? In our example, what is the amount of capital gain? What is the amount of capital gain? 78,93,000. What is the amount of exemption? What is the amount of capital gain exemption? That capital gain exemption is also 78,93. That is the reason your taxable capital gain is 0. Now my point is, my question is, SSC has opened a capital gain account and he has deposited some money in the capital gain account. Don't you feel if he would have deposited something less than 60 lakhs also, even in that case his tax liability would have been zero. In other words, don't you feel he has deposited more amount in capital gain account? Or in other words, if SSE doesn't want to pay any tax, if SSE doesn't want to pay any tax, means he says that my capital gain tax liability should be zero, in that case, he has already purchased a plot of land for 30 lakhs. So how much money he should deposit in the capital gain account? How much money minimum he should deposit in the capital gain account so that his tax liability will become zero? In our example, he has actually deposited 60 lakhs. That is okay. But my question to you is, what is the minimum amount which he should have deposited? In that case also his tax liability would have been zero. Is nothing but 7893 minus 30 lakhs. 7893 minus 30 lakhs, that is nothing but 4893. Instead of depositing 60 lakhs, even if he deposits only how much? 48 lakh 93,000. In that case also his exemption would be 7893 only, and in that case also his tax liability will be zero. In other words, can I say he has deposited something more? Definitely yes. How much more? How much more amount he has deposited? How much extra amount he has deposited? He would have deposited 48 lakh 93,000. In that case also his tax liability would have been zero only, but he has actually deposited 60 lakhs. So how much extra he has deposited is 11 lakhs 7,000. Vidyashree, not 41 lakh 7,000, 11 lakh 7,000. 11 lakh 7,000. See, amount actually invested in the property in acquiring the land is 30 lakh, that should not be taken into account. So how much extra money he has deposited? 11 lakh 7,000. Now listen to me carefully. This 11 lakh 7,000 he has deposited in the account. But do you believe that we have given some exemption for this 11 lakh 7,000? He had deposited this extra 11 lakh 7,000. But whether he has been given the exemption for this 11 lakh 7,000, yes or no? No, because his exemption is restricted to 7893. In other words, SSE should not deposit extra money in the capital gain account, because by depositing extra money in the capital gain account, he is not going to achieve anything. Only his funds will be blocked. And in this capital gain account, if you deposit money, then you are not allowed to withdraw. So before depositing itself, you have to decide how much amount I should deposit. So in this case, he has deposited 60 lakh in his account. Even if he would have deposited only 48 lakh 93,000, in that case also his capital gain tax liability would have been zero. In other words, he has deposited 11 lakh 7,000 extra. For that 11 lakh 7,000, we are not giving him any exemption. He has just deposited 11 lakh 7,000. Now his funds are blocked. We are not giving any exemption to him for that. Have you understood till this point? Yes or no? Okay. Now I am moving on to some other direction. Listen to me very carefully. See, this is the time limit for purchase of property. What is the date of transfer? 15th August 20. What is the time limit for purchasing new property? 2 years forward, 14th August 22. For construction, 3 years forward, 14th August 23. So those dates here we have written once again. Purchase 2 years forward, 14th August 22. Construction 3 years forward, 14th August 23. Now let me tell you that this money which he has deposited in the capital gain account, we have already offered him exemption. But what he has to do about that funds? Should he keep those funds in that bank account itself for lifetime? No. He has to utilize those funds either for purchase of property or for construction of property. And he has to complete the purchase within 2 years and complete the construction within 3 years. So, if SSE has claimed exemption by depositing some amount of money in capital gain account, then we are expecting him to withdraw that money and utilize for purchase or construction of property. Government says if you are unable to utilize that money within a span of 3 years from the date of transfer, on which date 3 years from the date of transfer will get completed? 14th August 23. On this date, 3 years from the date of transfer will get completed. Government says if you are unable to utilize, amount deposited in the capital gain account within a time span of 3 years from the date of transfer, then what we will do now? We will levy tax on the unutilized amount lying in the bank account. We will levy tax on the unutilized amount. Now, for explaining you how this calculation will work, I am giving you one number saying that amount utilized for construction up to 14th August 23 is 30 lakhs. Amount utilized for construction is 30 lakhs. Now you tell me how much amount was deposited in the capital gain account? 60 lakhs is deposited in the capital gain account. Now we are expecting him to withdraw these 60 lakhs and utilize these 60 lakhs for the purpose of construction of property within a span of 3 years. But how much amount he has actually utilized? He has actually utilized only 30 lakhs. He has actually utilized only 30 lakhs, and his time limit, his time span for utilizing that money 3 years from the date of transfer, his time span has already expired. That time span will expire on 14th August 23. This 14th August 23 will fall into which financial year? It will fall into financial year 23-24. That is previous year 23-24 and corresponding assessment year 24-25. Previous year 23-24, corresponding assessment year 24-25. Now government says if you are unable to utilize amount deposited in the capital gain account within a period of 3 years from the date of transfer, then what will happen? On the expiry of 3 years, we will levy tax on unutilized amount. On the expiry of 3 years, we will levy tax on unutilized amount. On which date this 3-year period will expire? It will expire on 14th August 23. 14th August 23 falls into which previous year? Previous year 23-24, corresponding assessment year 24-25. Now in this year, that unutilized amount will be made taxable. So we have to ascertain what is that unutilized amount. But for that, keep in mind, exemption can be taken back from you only if it was given to you. If I had given you some exemption, only to that extent I can take back the exemption. So now we are understanding out of the unutilized amount, how much amount should be taxed? How much amount should be taxed? Now you tell me, say for example, in my bank account, in capital gain deposit account, I had deposited how much amount? I had deposited 60 lakhs. I had deposited 60 lakhs. Out of this 60 lakhs, how much is utilized within a period of 3 years? 30 lakhs is utilized. 30 lakhs is utilized. So what is lying in my bank account? What is lying in my bank account is remaining 30 lakhs. What is lying in my bank account is remaining 30 lakhs. Now if I ask you, should we levy tax on this 30 lakhs? And if you say yes, then your answer is incorrect. Why now? Because we did not offer you the exemption of 60. We did not offer you the exemption of 60. Amount deposited in the capital gain account was 60 lakhs. We had given you exemption of 78 lakh 93,000. Out of this 78 lakh 93,000, we gave you exemption of 30 lakhs for purchase of land. Out of this 7893, we gave you exemption for 30 lakh for purchase of land. So, out of total amount deposited in the capital gain account, that is 60 lakhs, how much would have been taken into account for exemption? Yes? You had deposited 60 lakhs in your account, na? In the capital gain account. Your total exemption is 7893. So, how much amount was taken into account for the purpose of computation of exemption is 48 lakh 93,000. In other words, how much amount was not taken into account for computing exemption was 11 lakhs 7,000. This 11 lakh 7,000 you deposited excess in your capital gain account. We have not given you any exemption for this amount. We had given you exemption only for 48 lakhs 93. So if we want to withdraw the exemption, we can withdraw maximum to the extent of 4893 only. For 11 lakh 7,000, we have not offered you any exemption. So there is no question of withdrawing the exemption on the amount of 11 lakh 7,000. Have you understood this? Yes or no? Yes. Now listen to me. This is 4-line format. This is the 4-line format for computing the taxable amount in case of unutilized amount. If some amount is unutilized, out of that entire amount is not taxable. Out of that, how much is taxable now? For ascertaining that, I have a 4-line format. You have to follow this. First point is amount deposited in the capital gain account is how much? 60 lakhs. 60 lakhs. Out of 60 lakhs, how much amount was considered for computation of exemption? Out of 60 lakhs, we offered you exemption for how much amount? Only 48 lakh 93,000. 48 lakh 93. So, point number 2 I am writing, out of the above, amount exempt was only 4893. So, if I had given you exemption for 4893, I cannot withdraw exemption more than that. So, I can withdraw the exemption maximum to the extent to which I had given it to you. So, out of 60 lakhs which you had deposited in the bank account, exemption was offered to you only for 48 lakh 93,000. Now tell me how much amount you have utilized for the purpose of construction. You have utilized 30 lakh rupees. So for this 30 lakh, we have given you exemption and you have utilized the money. So there is no question of withdrawal of exemption. So how much amount is such that for which we had given you exemption but you could not utilize is nothing but amount number 2 minus amount number 3, that is 18 lakh 93,000. That is 18 lakh 93,000. Have you understood this very clearly? Yes? Have you understood the calculation of 1893 very clearly? See, now very important point to be noted is, in your bank account what funds are lying? In your bank account 30 lakh is lying, but we are not levying tax on 30 lakhs. We are levying tax on 18 lakh 93,000. We are levying tax only on 18 lakh 93 because we can withdraw the exemption only to the extent it was offered to you in the past. We can withdraw the exemption only to the extent it was offered to you in the past. Is that very, very clear? Yes or no? Yes? Now, in this diagram, I told you that up to the due date of filing return, Either SSE has to purchase or construct the property, or if he has not purchased nor constructed the property, then also if he wants to claim exemption, then what he has to do? Open capital gain deferred account, deposit money in that account, based on that you claim exemption. Once he has claimed exemption, what he has to do in future? He has to utilize money deposited in capital gain deposit account. He has to utilize money which is deposited in capital gain account. Within what time he has to utilize? 3 years from the date of transfer. 3 years from the date of transfer. What is the next point? Unutilized amount. Unutilized amount will be taxable. Will be taxable on expiry of 3 years period. Will be taxable on expiry of 3 years period. That is what I had explained you by taking an example. Now we want to last part of our discussion. Last part of our discussion with respect to section 54. Before I move on to that, I want to ask you from this example, same example I am asking you question. Listen to the question very carefully. If I ask you what is the cost of acquisition of your new house? What is the cost of acquisition of your new house? What is your answer? What is the cost of acquisition of your new property? You have sold the old property. On that there was a capital gain. You had an intention of claiming exemption. So you purchased the new property. You purchased the land. You deposited some amount of money in the capital gain account. You claimed the exemption. Then out of that amount deposited in the capital gain account, some amount you could not utilize. So some amount was made taxable to you. Now in this entire story, if I ask you what is the cost of acquisition of your new property, what is the answer? Yes? Have you understood the question? Do you want me to give you 2-3 options in MCQ form? Yes. So let me give you 2-3 options. Cost of acquisition of new property is option A 90 lakhs. Cost of acquisition of new property is 90 lakhs. This is option A. Option B, cost of new property is 48 lakhs 93,000. 48 lakhs 93,000. Option C, cost of new property is 60 lakhs. Cost of new property is 60 lakhs. And option D, cost of new property is 41 lakhs 7,000. 41 lakhs 7,000. Yes. Now you tell me what is the cost of new property. I have received answer from Akshaya. Have you understood the question first of all? You have sold the old property, on that you have calculated capital gain for claiming exemption, you have purchased the land, you have deposited money in capital gain account. To certain extent that money was utilized, to certain extent it was not utilized. Now what is the cost of your new property? What is the cost of acquisition of your new property in this case? Yes? Akshay has given the answer. What about others? Only if you get the answer, further discussion can be done. If you get the wrong answer, I will rectify. If you don't get the correct answer, I will rectify. So I have got answer from 3 persons. Akshay has given the answer, Dikshit has given the answer, Vidyashri has given the answer. Now, Parvez has given the answer, Akash has given the answer, Deva has given the answer. Now see, I will explain you. Lot of people have given the answer, but mostly answer is correct. It is 50-50. Now I will ask you a question. Yes, now more people are giving the correct answer now. I will ask you the question, simple question out of this. Tell me at what price the land was acquired? Plot of land was acquired for how much? Plot of land was acquired for 30 lakhs. Yes. So I am writing here. Plot of land was acquired for 30 lakhs. Correct? Okay. How much amount was deposited in the capital gain account? How much amount was deposited in capital gain account? Yes? 60 lakhs. Very good. So, 60 lakhs was deposited in the capital gain account. Out of this 60 lakhs, how much is utilized and how much is unutilized? How much is utilized? How much is unutilized? Can you tell me how much is utilized? Yes, definitely 30 lakhs is utilized. So what is unutilized? 30 lakhs is utilized and 30 lakhs is unutilized. Now if I ask you to ascertain the cost of acquisition of property, then definitely this land, it is an actual investment. Yes or no? Out of capital gain deposit account, you have utilized 30 lakhs. You have utilized 30 lakhs. So what is the cost of acquisition? Cost of acquisition of new property is 60 lakhs. Is 60 lakhs. It can't be 90 lakhs. Because you have not invested 90 lakhs in the property. You have not invested 90 lakhs in the property. You have deposited 60 lakhs in the capital gain account. But for construction of property, you have used only 30 lakhs. So your balance which is lying in the bank account, that cannot be considered as part of cost, no? Vidyashri, have you understood? 60 lakhs should be the cost of acquisition and not 90 lakhs. Dikshit had also given the wrong answer. Dikshit had given answer as option B. See, Dikshit, 48,93,000 is not the cost of acquisition of new property. 48,93,000 is the amount which was exempted out of the amount which was deposited in the account. Question was not on how much amount is exempt or how much exemption is offered out of the 60 lakhs. Question was, what is the cost of new property? How much money you have invested in new property? Your investment in new property can be more than the exemption amount also. See, in this case, for example, let me remove the complications and let me simplify the things for you, saying that whatever amount you have deposited in the capital gain account, entire amount is utilized. Whatever amount you have deposited in the capital gain account, 60 lakhs, entire amount is utilized for construction. In that case, what will be your cost of asset? In that case, your cost of acquisition will be 90 lakhs. That will be 90 lakhs. Now see, we did not offer you exemption for 90 lakhs. We offered you exemption only 78 lakh 93,000. That doesn't mean that your cost of acquisition will be 7893. The cost of acquisition is actual amount invested in property. Cost of acquisition is actual amount invested in property. So, before I actually move on to further part of our discussion, have you clearly understood that 60 lakhs is the cost of acquisition? Yes or no? Then only we can do further discussion, otherwise not possible only. So this 90 lakhs, 48, 93, 41 lakhs, 7,000, all these amounts are useless amounts. 60 lakhs is the cost of acquisition of new property. Now listen to me very carefully. I told you that if you want to claim exemption, exemption is allowed only to individual HUF. Capital asset transferred should be residential house property. It should be long-term asset. For claiming exemption, SHU should either purchase the property or construct the property. Within 2 years, 1 year backward, 2 years forward for purchase and 3 years forward for construction. If he is unable to do this up to the due date of filing return, then ask him to open the capital gain deposit account, deposit money in that account. Based on that, give him exemption and ask him to utilize that money within 3 years. If he is unable to utilize, then what? Then whatever amount he has unutilized, you calculate the unutilized amount levy tax on the expiry of 3 years. Have you understood this? Now I am moving on to the last part of our discussion. Purchase construction is point number 4. In that we have discussed everything. Let me make this as point number 5. And I move on to point number 6. Point number 6. Point number 6 says that whatever new property you have acquired, whatever new property purchased or constructed, whatever it is, purchased or constructed, government says we are putting a lock-in period of 3 years here. Lock-in period of 3 years. What government says? We are putting a lock-in period of 3 years here. Lock-in period of 3 years means SSE cannot sell the property. SSE cannot sell the property within 3 years. Lock-in period means we will not allow you to sell the property within 3 years. 3 years from which date? 3 years from date of acquisition or date of completion of construction. 3 years from the date of acquisition or 3 years from the date of completion of construction, we will not allow you to sell the property. We will not allow you to sell the property. This is the condition which is inserted. Now in this case there are two possibilities. Possibility number 1, 6A. SSE has not sold property. SSE has not sold property within 3 years. He has not sold the property within 3 years. In that case, what will happen? If SSE has not sold property, government had inserted a condition saying that you cannot sell the property within a span of 3 years from the date of acquisition or date of construction. SSE has not sold the property. So can I say SSE has complied with the condition? SSE has not sold property within 3 years. So in that case, what do we say? He has complied with the condition. If he has complied with the condition, in that case we say that whatever exemption was given to you, see, benefit is already given to you. Benefit is already given to you in the form of exemption. But benefit was given to you for purchase of property, and benefit was given subject to the condition that new property should not be sold within 3 years, and you have not sold. So, whatever benefit was given, that benefit will not be withdrawn. That benefit will be continued. Exemption will not be withdrawn. Why exemption will not be withdrawn? Because condition is fulfilled. Condition is fulfilled. 6b, second part. SSE has sold new property within 3 years. SSE has sold a new property within 3 years. Means he has satisfied the condition, or he has not satisfied the condition of lock-in period. He has fulfilled the condition or not fulfilled? Fulfilled or violated? He has not satisfied. He has violated the condition. So he has to face two consequences. He has to face two consequences. Number one, capital gain will be computed. Or let me say, capital gain will arise on transfer of new property. On transfer of new property, capital gain will arise. On transfer of new property, capital, definitely if you have sold the new property, you have to calculate capital gain. And exemption which was given to you earlier, that exemption will be withdrawn. That exemption will be withdrawn. Whatever exemption we had offered you, that exemption we will now withdraw, and we will levy tax. We will withdraw the exemption and we will levy the tax. These two consequences SST has to face. But these two, consequence 1 and consequence 2. What is consequence 1? Since he has sold the new property, we will levy capital gain tax on sale of new property. Consequence number 2, since he has not satisfied the lock-in period condition of 3 years, whatever exemption we had given to him was a conditional exemption, and since he could not fulfill the condition, that exemption will also be withdrawn. This consequence 1 and consequence 2 will be computed in combined manner, will be computed in combined manner. This is very important part of the discussion. Will be computed in combined manner means consequence 1 amount and consequence 2 amount will not be identified separately. The combined calculation will be done for that. Combined calculation will be done. For example, this is the last part of our section 54. Say for example, new property has sold within a span of 3 years and new property has sold for 1 crore 10 lakhs. At the time of sale of new property, 2 lakh is incurred expense on transfer. So the net consideration is 1 crore 8 lakhs. Now you tell me, what was the cost of acquisition of new property? 60 lakhs. So here I will write cost of acquisition of new property 60 lakhs. Ideally, what do we do? Ideally, what do we do while calculating capital gain? We deduct cost of acquisition from net consideration. If you deduct cost of acquisition from net consideration, you will get a capital gain of 40 lakhs on sale of new property. You will get a capital gain of 48 lakhs on sale of new property. But government says, don't deduct the amount of cost of acquisition from the net consideration. First of all, from the cost of acquisition, you deduct the amount of long-term capital gain exempted earlier. Can you tell me what is the amount of long-term exempted earlier to you? What is the amount of long-term capital gain exempted? Long-term capital gain exempted was 78,93,000. Long-term capital gain exempted to you is 78,93,000. But out of 78,93,000, already tax is levied on 18,93,000. Out of 78,93,000, which was the amount of exemption given to you, already tax is levied on 18,93,000, yes or no? That 18,93,000 tax is levied on unutilized amount. We had given you exemption for 78,93,000. Out of that, 18,93,000 is already taxed. So what is the benefit lying with you? Benefit lying with you is how much? 60 lakhs. 78,93 minus 18,93 is 60 lakhs. That amount of 60 lakhs you should deduct here. So this 60 lakhs is calculated as 78,93,000 minus amount already taxed 18,93,000. This 60 lakhs you should deduct here. The moment you deduct this long-term capital gain exempted earlier here, the cost of acquisition is 0. Every time cost of acquisition will not be 0. In this example, it is becoming 0. Cost of acquisition is 0. So your capital gain is 1 crore 8 lakhs. This 1 crore 8 lakhs, actually this 1 crore 8 lakhs is consisting of two things. This 1 crore 8 lakhs is consisting of two things. Number one, capital gain on transfer of new property is 48 lakhs. Now net consideration of new property is 1 crore 8 lakhs. The cost of acquisition of new property was 60 lakhs. So capital gain on new property is 48 lakhs. And balance 60 lakhs is nothing but exemption withdrawn. The old property which you have sold, we had offered you exemption of 78,93. From that already 18,93,000 exemption is withdrawn. So what is the exemption lying with you is 60 lakhs. That 60 lakhs exemption is also withdrawn. This is only for your analysis purpose. Not required to be presented in the examination, only for your analysis. Only for your better understanding. So, let me conclude by asking a very simple question. If you sell the property within a span of 3 years, you have to face two consequences. Consequence 1, capital gain will be calculated on transfer of new property. Exemption will be withdrawn. Whatever old property capital gain exemption was given, that will be withdrawn. This C1, C2 will be calculated independently or it will be a combined calculation. C1, C2, will it be kept separately? Will tax be levied on them separately? or it will be levied on combined amount? So answer is tax will be levied on the combined amount. What is that combined amount? 1 crore 8 lakhs. 1 crore 8 lakhs. Is that very, very clear? Yes. So our discussion with respect to section 54 is over. We need to just discuss 2-3 small points that I am not going to discuss today, that I will discuss tomorrow. So this section 54, you have to revise at home. Tomorrow when we start, by that time, you have to revise this section 54. Tomorrow, we'll complete this capital gain chapter, because what is left in this is 4 sections relating to exemption and discussion with respect to tax rate. 2 parts are left in this chapter. Most probably, around 4.5 hours, we will be in a position to complete the capital gain, and remaining 1.5 hour will be devoted to income from other sources chapter. So tomorrow we will be starting with the chapter of income from other sources.